We don't think AI is a bubble, but we want to now expand our investment universe of how to capitalize on this new technology.
You should stay risk on, but also thinking about which other parts of the market to be dipping into.
We are not hitting a wall. These things happen in a hyper-growth capex cycle.
How do we get a Euro rally? You just get volatility to calm down a little bit.
The narratives will get even scarier, but that's an even greater opportunity to be able to put capital to work.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks trying to rally for a second straight session, with futures adding to Friday's gains on hopes of a December Fed rate cut. You can see those futures up 0.2%. Oil easing amid ongoing negotiations to end the Russia-Ukraine war, with the U.S. pushing a 28-point peace plan. And all eyes now turning to a drip feed of data trickling out of the federal government post-shutdown, with retail sales and inflation data due out tomorrow. Danny, a real question here about how much they can fortify some of the bets that came into place on Friday.
Plenty to keep us busy heading into the holiday shortened week. But yes, it was last week. The kind of three bears come to realize it was the Fed, it was AI, and it was credit. It's hard to see how the AI and credit thing resolve itself one week. The thing that saved us at the end of last week that could continue this week is the Fed, and those dreams of a cut come to realize.
What's so interesting is, and I'm sure you've been reading all of the next full year ahead kinds of outlooks that we've been getting dripping into our inboxes. I feel bad for people trying to come up with a crystal ball, because good luck with that. But they all seem really positive. There is a buy the dip kind of moment. So where is that optimism coming from, if it isn't coming from some resolution to what you're saying of the AI and credit? Does it all sort of get predicated on the Federal Reserve?
And earnings. Everyone is pointing to earnings just to point out how strong they are, how resilient corporate America has been. April this time this year, it could not be further from the truth. So we're getting into this place again, end of 2025. Things look rosy for 2026, but again, we were very wrong at this time last year. So who's to say we're not wrong again?
We probably will be. Nonetheless, it's good to get a read of the temperature. You talk about the corporate earnings scene, and there have been a number of stories written recently about how little companies really have been impacted by tariffs, how it has sort of fallen back as some sort of issue that they really are focused on this morning. President Trump truthing, active truthing at 6 a.m. Eastern. The full benefit of tariffs has not yet been calculated, and that many of the buyers of goods and products, in order to avoid paying tariffs in the short term, stock up by purchasing far more inventory. The benefit will come to fruition. How much is this getting reintroduced in terms of an issue that could potentially come to the fore and be a note of uncertainty once again?
I gotta say, this almost feels like a warning for corporate America, saying you stocked up and you avoided my tariffs. That's going to end soon, and you won't be able to end it. He also ends the truth talking about the Supreme Court. This is on his mind. The Supreme Court has been really negative on the IEEPA case coming before them, as he's saying, it doesn't matter what happens at the Supreme Court. This is important for us. There's a benefit for America, and corporate America, pay attention, because you too are going to have to pay.
Yeah, and we're going to be catching up with Commerce Secretary Howard Lutnick later this hour. A real question around the European-U.S. relationship, not only from a trade perspective, but also when it comes to Ukraine, Russia, and how those negotiations continue. That 28-point plan very much in focus this morning.
It's going to take a mammoth task to get that passed, to get the Europeans and the Ukrainians to agree to something like that, just because it is kind of the worst fear come to fruition, that you had a plan talked between the U.S. and Russia and kind of shoved upon Ukraine. It complicates the task of Howard Lutnick as he goes to negotiate with the Europeans.
Right now, we are seeing that optimistic tone, although just building on Friday's gains, which you can see across the board. A lift to S&P futures, an even bigger lift to NASDAQ futures, up to 0.2% on the S&P. Euro gaining just about 0.25% versus the dollar, 115.42. 10-year yields just dipping by 2 basis points. Crude significantly lower. And last week, we saw crude traded on the NYMEX down 3.4% in anticipation of some of these peace negotiations between Ukraine and Russia. Coming up this hour, Katrina Dudley of Franklin Templeton as stocks look to find their footing. Marissa Adams of HSBC and why companies see increasing global trade in the years ahead. And don't miss this, U.S. Commerce Secretary Howard Lutnick with trade talks underway between the U.S. and the European Union. We begin this hour with stocks pushing higher as markets await a key week of data. Katrina Dudley of Franklin Templeton writing, we see the recent market volatility as a chance to reassess portfolios. Strategic reallocations could be especially rewarding as volatility often precedes periods of renewed growth. Katrina joins us now. Katrina, thank you so much for being here.
Great, thank you.
It seems like you fit in the category of buy the dip, and that last week and the week before's volatility was simply a buying opportunity in select areas. Am I getting that right?
Yes, you are. Have a look at the market. Have a look at how bearish and neutral the market is. It's like 68% of investors are in either that bearish or neutral camp. So you're buying these dips, but you're also buying into what we call this wall of skepticism. And it's not necessarily a wall of worry, but the skepticism. And that skepticism is predicated on concerns, as Danny just said, about your AI, about private credit, and obviously what's going to happen with the Fed at their December meeting. So those three things are kind of weighing on investors' minds, but we actually see going into 2026 a very optimistic scenario playing out.
So we're going to get to AI and some of the questions around the debt build out in a minute. I am curious, though, just about the state of the consumer and how important that is heading into next year to determine whether you can see this melt up, the 7,800 predictions for the S&P at the end of next year. How crucial is this season of retail spending?
I think we're going to have 3 earnings reports this week, which will give us a little bit of kind of the feel of where the consumer is at. So you want to watch those earnings reports carefully. The second thing, though, is we're watching into the Christmas season and what is happening during that holiday season in spending, because we do need to have a baseline consumer that is continuing to spend. Now, from a perspective of the tariffs, you're right. A lot of companies have forward bought inventory, so we don't think there's going to be quite as much sticker shock as people walk into retailers. And I think finally, we are talking about a shortened week from a trading perspective, but let's be clear, it's Black Friday. So we're going to have people on the ground, and we're really going to get that data so much quicker this time around. So we're going to have a real temperature check on the consumer. And I think that is going to be the underpinnings and the start of addressing some of this reticence we've seen in the market.
But we've known that the consumer has continued to spend. How do you weigh up if you get some of that strong data from Black Friday versus the AI and credit parts of the narrative? If that continues to look shaky, can the consumer kind of supplant that and win out and allow a rally to continue?
I think what's the shakiness is people are just wondering about how are we going to fund all of this AI capex. But let's take a look at what the real arbiter of how markets work, and it's earnings growth. And going into the third quarter, the expectations for earnings growth was 6.5%, and we came in at 15. So companies are really starting to earn. And yes, we do hear the narrative about concerns on debt leverage and AI, but I look at the breadth of where AI spending is happening. I look at a company like ourselves. We have a pristine balance sheet, and we're investing significant amounts of money into AI in various parts of our business, and we're not using leverage to do that.
Well, is it fair to argue, though, that we've at least shifted? We're not saying this is a bubble bursting, but we've at least shifted into a phase where it's cautious evaluation for AI companies. And if that's the phase that we're in now, what does that mean about how much more juice can be squeezed out of the AI trade and have these mega cap companies really support the overall market?
Look, you've gone in terms of AI from having this kind of use cases and 400 use cases what we started, we then narrowed it down, and now we're starting at that phase of we need to get those use cases into production. And that's the part of AI that you're really talking about. And I do think it's so important. It's taking use cases into production and then seeing the returns from that production. And we're now actually starting to see the ability to calculate some of those returns in areas where it was a little more difficult. So how many hours of time saved for an expensive executive do we get from using an AI summarization or an agentic AI tool to generate information for them? So we're now actually starting to see calculations of time saving. We're also starting to see, calculations of are there cost savings associated with this. And it's the ROI and the need for ROI that I think is going to be the next underpinning of what is a bullish AI narrative.
Meanwhile, with AI definitely on the back burner and a question of how much patience investors have, there's also a question of how much stimulus there will be pumped into the market early next year. I'm watching the headlines drop about President Trump clearly very focused on cost of living. We've seen certain tariffs rolled back, a real question of what happens if the Supreme Court overturns the existing tariffs. How much are you looking to both the Federal Reserve to cut rates, but also to some sort of fiscal impetus at the beginning of 2026 to fuel some sort of upside across the board?
I think as we look into December and I look at rate cut expectations just a few weeks ago, I mean, the market's really telling you that December we're not likely to see a cut. And the reason is that the Fed has been so much behind that. We are data dependent. And one of the unfortunate consequences of the shutdown is some of this data is going to be delayed. And the most important piece of data on the jobs front is actually going to be delayed until after that meeting. So I think that from a Fed perspective, with a degree of caution, they're likely to enter into that December meeting with the data is not here. We don't want to cut too much more. And they're going to punt that into next year. So that increases the likelihood that next year we may have a small cut. But the fact is, let's go back to the inflation number, and that's really the part of this equation we are focused on. You know, inflation continues to not be contained. And so we need to be cautious, because if we don't get inflation, you're back with a 2 handle on it on a long-term basis. The ability of the Fed to cut, we think, is really hamstrung given some of the employment numbers.
So highest conviction, long stocks, short bonds, or long stocks, neutral bonds?
My conviction is continuing to be long in the market, and I think that what we keep going back to is the fact that there's skepticism. There's really this idea that we're seeing a skeptic investor, so we think it is an opportunity to add. And then finally, we like the breadth. I mean, that's the real thing that I think is, even during this year, has been clouded, is we went into this year saying we wanted to have breadth in the market. We started to see it, but then the Mag 7, with all of this AI rhetoric, accelerated again. And I think going into 26, our call is for a continued expansion of breadth in the market. So it's focusing on the 493 stocks, as we talk about, that really are going to drive the market.
The great hopes and dreams of the equal 493, or the equal weight S&P 500. Katrina Dudley, great to see you. Thank you so much for being here. Katrina Dudley of Franklin Templeton. We are getting some headlines reported by Politico that Trump's health care plan sees a 2-year ACA subsidy extension. Danny, really interesting to see how this narrative has flipped after the reopening of the government and a clear focus after the midterms on cost of living concerns.
I say, because it's not just health care. It's also been trying to bring down tariffs with Brazil. It's been the administration going out there and talking about the need to cut to help housing. It's a Trump and a Bessent and a Hassett. Everyone is concentrated on this issue of affordability. It's underscoring everything. And again, healthcare, this was the sticking point for reopening the government. It was a GOP that said, we'll vote on it again in December to allow the Dems to come around and vote. So it's interesting to see the president come out and say something like this. Of course, he hasn't said it, it's reporting, but allow for that 2-year extension to ACA.
Yeah, and we're expecting more details. Treasury Secretary Scott Bessent over the weekend saying that he was going to unveil some more details on healthcare. This is perhaps some of that. We'll bring more to you as we get it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Well, as you've been saying, Treasury Secretary Scott Bessent saying the Trump administration is planning a healthcare announcement this week. Bessent is urging Republicans to come up with a plan by January 30th to address health insurance premiums. The premiums are set to spike when subsidies expire at the end of the year. Several airlines are cancelling flights to and from Venezuela after the U.S. issued an advisory urging operators to exercise caution amid an escalating standoff between the two countries. The FAA has also reported rising interference with navigation systems in Venezuelan airspace. President Donald Trump active on social media this morning, posting on Truth Social. Despite the massive amount of money being made by the U.S. as a direct result of tariffs being charged to other countries, the full benefit has not yet been calculated. Trump also weighing in on yesterday's New York Giants football game, writing, quote, "Why did the New York football Giants not kick that field goal? Who would have done such a thing? It was crazy." Well, that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, Peace Talk Progress.
I think we've made good progress. So we're working through making some changes, getting closer to something that both Ukraine and obviously the United States are very comfortable with.
Terry Haines of Pangaea Policy joining us next. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Futures trying to take that lift from Friday and extend it with a little bit of a rebound with all the year ahead forecasts talking about some sort of buy the dip moment, sort of a tepid buy the dip moment. Futures up only 0.1% for the S&P. Euro gaining just a bit. 10-year yields just a touch lower, 2 basis points. Crude very much in focus with the ongoing talks between Ukraine and Russia. Crude down 0.4% today. Last week, crude traded on the NYMEX down 3.4%, some of the lowest levels since October. Under surveillance this morning, peace talk progress.
It is in my personal view that we've had probably the most productive and meaningful meeting so far, and I think we've made good progress. So we're working through making some changes, some adjustments, in the hopes of furthering narrowing the differences and getting closer to something that both Ukraine and obviously the United States are very comfortable with.
Here's the latest. U.S. and Ukrainian officials making progress on a new version of a peace plan ahead of President Trump's Thanksgiving deadline. Bloomberg's Oliver Crook joining us now from Brussels. Ollie, how close are we to some sort of agreement between the U.S. and Ukraine on a 28-point peace plan that they can get behind?
Yeah, I think, Lisa, it's going to be very difficult to see until we actually see the text of this plan and the latest iteration of it after those 24 hours of kind of frenzied negotiations over in Geneva, led by Andrei Yermak from the Ukrainian side and Marco Rubio with his whole delegation from the United States. There is apparently now a new text that is circulating. We have not yet seen it. But again, it's very hard to tell what these kind of Ukrainian and the European position is on this, because this is the sort of golden rule of diplomacy under the Trump administration, is no one can be completely candid about how they feel exactly about the text. Everyone has to say, yes, this is a great framework. We're going to work on it a little bit and we're going to go send some input. So until we actually see the text itself, it's going to be very difficult to determine how close either side is for the Ukrainians and the Americans. And of course, it still needs to get another pass by the Russians. And that is going to be another point of this conversation that is by no means a sort of secured and done deal. But that is the sort of state of play now, 24 hours. I just spoke to some foreign ministers from the European side here, who we should say notably have been iced out of all of these discussions yet again, the diplomacy train leaving the station with the Europeans not aboard. The question is, how do they get their seat at the table? And I think that the main way that they can do that, the main lever they can pull, is to start to act on those Russian assets that they still hold here in Belgium. They've been bickering about it for the last couple of years, 140 billion euros that are still sitting here in the Belgian accounts, about what they're going to do with that, whether they're going to get a loan, because that will make a complete difference in terms of the calculus and the negotiating position for the Ukrainians, not having that money in the account versus having that money in the account, and basically saying, we can wage this war, the Ukrainians, for the next 2 years. We have the money. We'll make all the difference. The Europeans at this point have still failed to do that.
Ollie, just quickly here, how realistic is it that the Europeans are going to take those assets that are from Russia, co-opt them, and give them to Ukraine?
Well, this has been the perennial debate, so they wouldn't really take the assets. That is really the red line, but they have some financial engineering where they would basically put up a loan of 140 billion euros and then use the assets as sort of collateral, and they have this sort of a way of financial engineering to try to get those to the Ukrainians. But the other point we should make here, Lisa, is part of the 28-point plan, there were ideas for the Americans had about what to do with those Russian assets. So the real question is, are those still even on the table? I think for the Europeans, what they need to decide is, are we going to make an action on this? Are we going to take this action? Or are we going to stop talking like we are a geopolitical superpower? Either the rhetoric needs to change or the behavior needs to change. Both can't go on like this in Europe.
Ollie Crook in Brussels, thank you so much for being with us and all your reporting. Joining us now, Terry Haines of Pangaea Policy. Terry, why the push before Thanksgiving, albeit with a flexible date from the Trump administration?
I think, frankly, you get to the situation where the president is tired of the lack of progress. The president has been saying since the beginning of the year that he's interested in ending the Ukraine invasion and bringing peace into that region. And now it's been three and a half months since the Alaska summit. Nothing's happened. As Ollie pointed out at the end of his talk, the Europeans continue to spout rhetoric without results or an additional push. As I've been saying since the Alaska summit, the two most important parties in this negotiation really aren't the United States, aren't Ukraine, aren't Russia. It's the Europeans and the Chinese. It's what are the Europeans willing to do to push, and what are the Chinese willing to let Russia do in order to end the thing. And so I think what the president's doing is trying to hotfoot Europe yet again.
So where are those lines that can be drawn, Terry, between the Europeans, between China? Where do you think things like ceding territory in Donbass, making Ukraine be okay with less troops, having them not accept NATO membership, can any of those lines be moved?
I'm sure. In what you get from the parties in the last 24, 48 hours is that none of that stuff is set in stone at all. So this is much more a matter of, the president also has said over the past few months that he looks at himself as a mediator more than anything else. He's a mediator and he's not, since he's going to be involved in a security guarantee. But at the same time, what this is about, I think, is about putting together the strongest position that the United States can agree to, that the Europeans can agree to, and the Ukrainians can agree to, and see what they can get out of Russia. I mean, the worst case scenario here is that all those parties are together. Russia, which has never endorsed this proposed deal anyway, says no to it. The best case is it's grounds for continued negotiations. So I think those are the two alternatives.
Well, Terry, you write about that setting that Thanksgiving deadline, as squishy as it is or not, is a whopper of an optics misfire. Not being able to meet that deadline, how does it in turn impact Trump's push on domestic policy?
Well, there are two things. One is that I think the president, I did criticize the U.S. Thanksgiving deadline as being bad optics, and I think the administration partially understands that, because they're willing to sacrifice it. Rubio has said that he's not interested in a hard deadline there, and that's a good thing. How it affects the domestic. That's going to depend on how unified Trump and Republicans are on domestic policy. So far, they continue to be, and how unified they're going to be on foreign policy. And the signals that the Trump administration was getting from the Senate over the weekend were not positive signals on whatever the original plan was. So what you're going to see, I think, is a position that is much more indicative of Republican unity across the board, and probably a lot of Democrats will support it as well.
We're getting a lot of truths this morning from President Trump, talking about everything from tariffs to the giants. And there's a real question here going forward about what is behind some of the recent pushes and some of the impetus that he's had, whether it comes to dropping tariffs on bananas and coffee, or whether it comes to some of the push between Ukraine and Russia. How much do you see a real pivot in the Trump administration after the midterm elections to some sort of pro-consumer friendly policies, whether it's dropping tariffs or whether it's those $2,000 checks, the tariff rebates early next year?
I don't see a pivot. I see a change in emphasis to some extent. They're not going to change their policies, certainly. And and dropping tariffs on coffee, for example, it isn't a pivot on tariffs. Besson's been very clear about that, and I think that's obvious. What they're doing on tariffs at root doesn't have much to do with foodstuffs, but and that's not the most important part of that policy. But what I do think they're doing is being practical and emphasizing practical results. It's a mistake to think about to Trump as a Democrat or Republican, an ideologue of some kind. At root, I think the president is interested in solving problems. If he can solve problems without federal involvement, that's great. If he can solve problems with a lot of federal involvement, that's great. He's much more interested in solving problems, and I'm not cheerleading by saying so. I'm just talking about his orientation since day one in office. And they'll continue to do that. And that's been a more successful policy for them than the adherence of either party to ideology.
Terry Haines of Pangaea Policy, thank you so much. And have a wonderful Thanksgiving. Coming up, HSBC Regional Trade Head Marissa Adams as U.S. negotiations heat up with two major partners. You're watching Bloomberg Surveillance. It was a bruising week last week with a decline of 1.9% on the S&P 500 for the full week. Even with a rally staged on Friday, the Nasdaq was down almost 3%, led by those mega tech names, with the one exception being Alphabet, Google, with the support potentially of Berkshire Hathaway. This morning, trying to continue some sort of rebound up 0.2% on S&P futures. Nasdaq also continuing to recover 0.4% gain, with a real question here about whether certain key names have been oversold. Russell 2000 flat. A real question here about how the U.S. consumer is going to weather through the storm. Meanwhile, if you take a look at the bond space, you can see yields slightly lower across the board as people look to a Fed that at least New York Fed President John Williams seemed ready to cut rates as soon as next month. A real question here about what this would do to the long end. 30-year yields lower. We do have a 7-year auction on Wednesday right before you head out on Thanksgiving weekend, so do not miss that excitement. Meanwhile, what you can see in the oil patch is oil continuing to lose value in the face of potentially some positive reconciliation between Ukraine and Russia, potentially those peace talks continuing between U.S. and Ukraine this morning. We are seeing crude traded on the NYMEX down 0.3% following last week's decline of some 3.4%, which brings us to under our radar this morning. U.S. and Ukraine preparing an updated version of a Russian peace plan ahead of President Trump's Thanksgiving deadline. Despite mounting contention over the 28-point proposal, both sides reporting they are advancing toward a deal.
I don't know how Ukraine does anything but use this, at least for a basis, even if it's really unsavory, because their options are kind of completely reject this, get cut off of U.S. aid, which even though a lot of U.S. aid has been pulled back, it would really hurt for them, or just kind of push it down the road and continue to fight. Can Ukraine, do they have that potential to keep fighting? I think, though, that this is kind of the worst fear for the Europeans, though, the idea that you would get the White House and Russia together deciding a plan without the Europeans, without the Ukrainians, and shoving it down Kyiv's throat. I mean, this is what happened. You had the head of the Sovereign Wealth Fund and Steve Witkoff. They developed this 28-point plan, at least that's what the reporting suggests, to the point where some of the sentences in it were like direct translations from Russian, where some of the sentences and word structure was really awkward. So it's not ideal, but it's kind of all the Ukrainians in Europe have to work with at the moment.
And it seems like at least the U.S. administration is split between Steve Witkoff on the Russian side and Marco Rubio on the Europe and Ukrainian side. Who will win out? Meanwhile, Treasury Secretary Scott Bessent confirming that the Trump administration is finalizing plans to significantly reduce the costs of health care across the United States. Bessent saying an announcement to address the issue is planned for this week, which is the reason why both of us got our antenna up when we saw that Political report talking about a potential extension to the ACA subsidies.
It's interesting that both these stories have this bend of affordability and the affordability crisis to it. On one hand, yes, Trump wants to solve Ukraine because he promised he would. But you pointed out, Lisa, it's been lowering oil prices. This is also a part of affordability. After those losses in the gubernatorial races in New York City, Mamdani was just in the White House. It is a real focus from this Trump administration to find different things to try to bring affordability down. It's a careful needle to thread, though. How do you extend the ACA subsidies without embracing ACA? And that's what the conservatives in Congress don't want to see.
So some details from Politico on exactly that point. The health policy framework that the White House soon is expected to unveil, this according to Politico, would include a 2-year extension of Obamacare subsidies due to expire at the end of next month. However, there also will be new limits on eligibility, so possibly creating that kind of stick to cater to some conservative worries. Nonetheless, the fact that you point out that Mayor-elect Mamdani and President Trump met together, the discussion was about how a lot of them have the same priorities. The real question now is, how do you get there?
Exactly. Greg Ip of the Wall Street Journal was writing about this over the weekend, and I thought he was right on point. The idea is it's really easy to campaign on affordability because everybody feels it. It really hurts. How do you fix it? It's not one solution because it's food prices, it's housing, it's wages that aren't keeping up as much with inflation. There's not one policy that fixes all those things. So sure, you can campaign on it, and maybe that's what the mayoral-elect will find. But actually solving it, that's incredibly difficult.
Well, maybe the Fed can do it, because that seems to be what everyone is hoping for, at least in markets. White House advisor Kevin Hassett, who is a top contender to become the next Fed chair, saying President Trump will interview finalists over the next 2 months, targeting New Year's for appointing the next head of the central bank. I thought this was already over. I thought we were already supposed to have somebody in mind. Now we're getting sort of flipped to the beginning of January. I don't understand what's taking so long, given how long this speculation has been ongoing about who will be the next
Just
Fed chair.
in August, they said they already narrowed it down to 3 candidates. I'm looking at 4 candidates up there. So apparently it's grown and shrunken and grown. Maybe the good news is that like the big fear of the market that we'd have a shadow Fed chair who would come in and say the opposite of whatever Powell would say and create confusion in the market. That didn't happen, right? Because they can't decide who it will be. I guess the flip side is there's confusion without that, because this is such a divided Fed. You don't need a shadow Fed chair to have opposing voices right now.
You can, though, have someone who's just sort of the poster child for it's your fault in Jay Powell. Keep him there for as long as possible, not have a new person to really take the blame, and then push that as long as you possibly can. Meanwhile, a lot of us have been talking about how trade was such a huge issue just in April, and now where is it? Where has it gone in terms of being the dominant issue on earnings? The big questions remain on the outlook for global trade, with negotiations still underway among top trading partners. HSBC publishing its Global Trade Pulse survey, finding 94% of U.S. companies believe they will increase international trade over the next 2 years. That is above the global average. Joining us now is Marissa Adams, HSBC's Europe and America's regional head of Global Trade Solutions. Marissa, can you riddle me this? We were talking about how the U.S. is becoming increasingly isolationist, and instead it is the leader when it comes to plans for international trade. Can you square the circle?
Absolutely, and thanks, Lisa, for having me on again. What's really interesting, and we've just surveyed over 6,500 companies globally, 1,000 here in the United States, and U.S. companies, as you said, are more optimistic than their global counterparts about growing international trade. 3 key reasons that we see for that. One is that I think for U.S. corporates, they've been really close to the tariffs, and particularly the policy. And so this is something that's become almost second nature to them in terms of how they look at their businesses. Secondly, they are being really innovative around how they invest in AI, in other cost efficiency type efforts. And I think because of that fact of that closeness, it's really meant that they've doubled down on it. And thirdly, what we've seen is a real sense of diversification for U.S. corporates, both in their supply lines, but also demand markets. And I think when we talk about tariffs, we often talk about supply chains, but actually it's been a great opportunity for U.S. corporates to look at other markets to sell their products. We've seen a great increase through our survey of companies looking to Australia, Japan, the European Union, perhaps markets they hadn't focused on before. So that's where we see that optimism coming from those U.S. corporates that we surveyed.
What about outside of the U.S., Marissa? We saw reports this morning about how Canada is getting closer to China, to even other areas that the U.S. is a little bit more adversarial with. How much do you see the rest of the world moving away from the United States in terms of trade?
So I think it really depends industry by industry. And so if we look at the consumer sector, certainly there is a focus for certain corridors, a huge focus on Europe to Asia, Europe to the Middle East. But the U.S. still remains the largest demand market in the world. What I would say is in certain sectors like the tech sector, healthcare, where the U.S. is a leader, there isn't really a pivot away from that. And so what we're seeing is how corporates are able to absorb those costs, look at different diversification strategies. But ultimately, the rest of the world, whilst they are looking at new corridors, will still remain incredibly dependent on the U.S., particularly because of that large consumer market, as well as the advanced sectors where very much the United States leads in.
Well, Marissa, to the point of cost, you say in your survey, 48% are revising their pricing strategies. They're absorbing the cost for now, Marissa, but going forward, what do those pricing strategies look like?
So really interesting sector by sector. If we look at the consumer sector, they have tried as much as possible to hold those costs back, but they are starting to pass those on to consumers. We've also seen that some of those consumer retail companies are actually looking to move up the value chain. Not all consumers are equal, so looking at where there's actually more opportunity perhaps in the higher end consumer where we've seen less pressure. In the industrial sector as well, we see renegotiations with suppliers in an effort to really amend those pricing terms. So that's what we're seeing across the board. I'd also want to come back to the tech sector, who have really been, and our report shows this, have been, I suppose, the most innovative and also the most aggressive in terms of their supply chain management. Some of that obviously to do with tariffs, but I'd say also in terms of the AI race is something that's driving them to really diversify across the board.
Marissa, how much of the shift do you think is permanent? And I ask because IEEPA, in the case around tariffs, is in front of the Supreme Court now. If that were to be struck down, is this a global supply chain that would be looking to get back into places like China? Or are these shifts here, now, and forever?
So I can't comment on what may or may not happen from a Supreme Court judgment, but I would say that some of these are permanent shifts. And I think some of that has actually been a result of the fact that there has been a little bit less focus on expanding new demand markets, as we mentioned. There's been this push towards supply chain resilience, and we've seen over the past 4 or 5 years reshoring or regionalization. This has accelerated it. So regardless of where the ultimate tariff landscape lands, I do think this is actually a fundamental shift, and we think about the geometry of where it goes through to of the tariff landscape, and actually a positive one, I'd say, for a lot of corporates. One thing they are also looking at is working capital, and our survey was really clear on this, that even corporates at the top end are feeling a liquidity squeeze. 1 in 5 corporates are saying that liquidity is becoming a challenge. So we're looking to see how we can support those companies, both from a bank financial perspective, but they're also looking to alternative credit to finance those supply chains and that expansion globally.
Marissa, we saw an active Truth Social feed this morning from President Trump, and one of the issues on his agenda had to do with tariffs and how a lot of companies have been front-loading all of their inventories in order to sideswipe some of these tariffs, but that certainly does seem to be wearing thin, as he said. And soon tariffs will be paid on everything they apply to without avoidance, and the amounts payable to the USA will skyrocket over and above the already historic levels of dollars received. On one hand, from the U.S. budget, that could be positive in terms of filling the coffers. For these companies, does that mean that there is likely a higher bill to have going forward than is currently being realized? In other words, the effects really have not fully been felt.
So if you look at what the tariffs have achieved so far, and to that revenue point, they have achieved revenue. U.S. Customs and Border Protection is estimated to collect approximately $200 billion in tariff revenue this year. That's $77 million at the year end of last year, so significantly larger. So those tariffs are already coming through, and a tariff is paid at the point of import. So even when goods have been front-loaded, they have paid for those goods coming through. Could we see more coming through in the future? Potentially. But I'd say also you look at the fact that not only have you had that revenue from a tariff perspective, you also had a bit of reciprocity. So if you look back pre-April 1st or April 2nd, a lot of countries actually did have higher tariffs for U.S. products going into those nations, the European Union, Japan. And as a result, as a couple examples, as a result of the tariff initiatives, a number of those tariffs have actually come down. So it's cheaper for those U.S. goods to go abroad as well. So you're seeing a real rebalancing across the board that, again, hasn't quite come through the numbers yet, but we're certainly starting to see from a sentiment perspective, but also from the trade corridor perspective as well.
Marissa, when it comes to stockpiling and inventories, for this Black Friday shopping season, how is the consumer sector set up? Have they been building up stockpiles? Have they been more reticent this time around?
It really depends on the goods. So obviously certain goods, and I think one of the best examples is a banana. It's really hard to stockpile a banana given the shelf life of it. So we have seen in certain sectors, I'd say particularly in the consumer retail, if we look in fast fashion, if we look in some of the other core goods, there was a drive to have inventory. This is not also new to the tariff regime at the moment. We saw that around potential supply chain disruptions. And what you'll see obviously in our report is that any conglomerates and consumer goods, they've actually seen that some of the increasing costs in shipping have been a reason that they've tried to figure out how to bring more inventory into the country sooner. What this does do is put pressure on their working capital and their cash. So the longer you're holding inventory, the longer you don't have that cash to release for new investment, for new product development. So it's been a bit of a fine balance industry by industry, but certainly there has been a desire. And I think some of this even comes from the disruptions of COVID, that you don't want to not have that inventory ready for when those sales are coming through. So it's been a balance for companies on how they balance that working capital need with also the security of having that inventory in the country ready for, as you say, the Black Friday season, as well as Christmas coming through in a few weeks.
Marissa Adams of HSBC, thank you so much for being with us, and have a wonderful weekend if you are heading out early. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Israel is saying it killed Hezbollah's military chief in a rare airstrike on Beirut as an almost year-old ceasefire deal with the Lebanese government wavers. The IDF says the attack killed Hezbollah's chief of general staff, the group's second in command. According to Lebanon's health ministry, the strike killed 5 people and injured 28 others. BHP is ending a fresh attempt to acquire Anglo American rejecting BHP's new approach, saying a proposed combination with Teck Resources is superior. BHP's decision comes before Anglo and Teck shareholders are scheduled to vote on their planned tie-up. That would create a company worth more than $60 billion. Shares of Novo Nordisk sinking in the pre-market after studies showed a pill version of Ozempic failed to slow the progression of Alzheimer's disease. The trials coming as a long-shot effort to open up a new use for blockbuster obesity drugs. Novo will discontinue a planned one-year extension of the studies. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, reshaping global trade.
We've started to reshape the global trade system in a way that we think is better for America.
We must also act decisively to defend Europe's interest.
Trade talks are underway in Europe. U.S. Commerce Secretary Howard Lutnick joining us next. This is Bloomberg Surveillance. A lift to start the week, potentially, although just in terms of building on the rally that we saw from Friday. Futures up pretty much across the board, led by the NASDAQ, the tech giants in particular. One company I want to point out, Google. Alphabet shares up almost 3%. They have been the outperformer based on Berkshire Hathaway. But Danny, this one's coming with a little bit of additional news over the weekend.
Yeah, the information reporting that Gemini's latest update was so good that Sam Altman, the guru of AI, the one everybody looks up to, sent out a memo saying the vibes, they are rough. That's like literally not me paraphrasing. He said it is rough vibes and revenue could collapse to 5% as they race to catch up to Google. Not what you want to hear from like the beacon of AI hope.
Yeah, the rough vibes, especially painful given the fact that they have borrowed so much money and leveraged so much of the AI ecosystem to their success, given the fact that potentially they could get beaten out by Gemini, the latest reiteration. So to me, this really goes to the question of, are we seeing the winners and the losers really playing out in markets in real time? And does it lead to an overall bet one way or another? Or are you seeing this dispersion increasingly in terms of market performance?
It's such a good point because at one point we were trading that all of the hyperscalers, all of the AI related names, that they would all do really well. And it's because the way this market traded was an idea of super intelligence, was agentic AI, and that was the thing that was going to lift all boats. Instead, the market has started to be more discerning and saying, okay, that thing out in the future, we care less about that. What we care about now is turning profitability for AI. It's that near-term thing. It's that less like squishy future that we've all been promised and what's happening here in the now.
Right now, what you are seeing in the now, you are seeing stocks get that lift, particularly led by the NASDAQ, by big tech, by Alphabet in particular. Given some of the latest news, you are seeing a little bit of a bid into bonds, yields lower across the curve, 2s, 10s, and 30s. You are seeing just a couple basis points lower on the 10-year. Meanwhile, crude prices are lower as people look to Europe and see potentially some sort of agreement between the Ukraine and Russia, a sense that maybe oil prices could keep pushing some of the lowest levels that we've seen going back to October. A real question here about how much this is reshaping the landscape, Danny.
Yeah, I mean, lower oil prices also certainly helping for 10-year yields, too. And maybe it's part of the reason that President Trump has been pushing for this before Thanksgiving. Because not only is it something he promised in the campaign that he could end very quickly, but it's also something that has an implication for inflation. It's a very multi-pronged approach that it feels like this administration is taking to say we're going to try to lower the price on coffee coming from Brazil. We're going to try to lower the price on bananas. Why not throw oil in there, too, if you can? And at least that's what we saw last week of a steady drop in oil prices.
And there have been these ongoing trade negotiations between Europe and the U.S., between China and the U.S., between the U.S. and the rest of the world. And a real question has been how much these new cost of living or re-emphasized cost of living concerns will hamper or potentially feature in some of these discussions in terms of where you get deals, where you don't get deals. We've seen that with respect to bananas and coffee. We've seen that with respect also to other commodities in South America and the relationship between Argentina and the United States. A question here about how much the U.S. is going to seek strategic relationships with key allies in order to solidify some of the resources that the U.S. doesn't produce at home.
It's this confusing time because it's also a Trump administration realizing that a lot of this matters for the market. And I go to the discussions with China over NVIDIA chips, too. There was also some reporting that they would allow some H200 chips into China. It's this question of what's the trade-off between economic security and at the same time providing a populace with prices that aren't too high. Again, we were just talking with HSBC, the fact that a lot of companies have made different pricing plans, that they've been absorbing the prices. And then you get President Trump this morning. We've been talking about his Truth Social post warning that the stockpiling was going to end and that companies would start to be paying the tariff price. So on one hand, you have him trying to lower prices on things like coffee, on bananas. On the other hand, he's warning corporations, you're going to have to pay more. It's a push and pull right now.
Which really goes to the point that the Wall Street Journal highlighted over the weekend. We saw this article where they talked about analyzing 5,000 calls of certain earnings reports, and they found fewer and fewer references to tariffs, talking about how the actual price paid by a lot of these companies was about 12% on average, blended. About 3/4 of it was passed through to the consumers versus 100% during Trump 1.0, when there were fewer items that were really put into place. This is really important heading into holiday season when people are wondering about the elasticity, how much consumers are going to be potentially absorbing the costs and how much tolerance they'll have of them. But we have been hearing pretty positive news from a lot of retailers, which I find absolutely fascinating.
I thought one of a really good quote, just to remind everybody of, in the Wall Street Journal story, was in February, where Jim Farley at Ford said that the proposals at the time would have a huge impact on our industry, with billions of dollars of industry profits wiped out. And at the time, you saw those auto companies trading really negatively. Instead, what did we get from the earnings? Everyone's buying heavy trucks. Everyone's buying really expensive cars. Things did not play out the way we expected them to. It was a really humbling year, and maybe a good reminder as everyone's putting together the 2026 forecast.
Well, and some people have noted, and I know that Yardeni is coming up, and one thing that he has talked about is that the stock market's not the economy, but kind of it is, because increasingly the stock market gains have really fueled a lot of the consumption at the upper end. And so if the stock market does decline materially, you could see the one ballast of the consumer economy lose some steam, and how problematic that could potentially be. And so you wonder at this point how much the Fed is between a rock and a hard place. On one hand, they want to support people who are on the lower end who could lose their jobs. On the other hand, you're dealing with the potential for a stock market shock that would eliminate one of the one bastions of this particular economy.
That's part of the reason why last week's sell-off, I mean, I hate to use the word ironic because obviously it was very painful for a lot of people, but there was some irony behind it, because part of the reason you got the sell-off, or at least that initial shove to get the sell-off happening, was a hawkish Fed. So you had fears that the cut's not coming. The market sells off. The market sold off badly enough that people started assuming that a cut would come, that the Fed put would come back and would rescue the market. We heard from Williams. That was the thing that saved us all. So yes, it was AI, it was credit concerns. But the real thing that's allowed the market to sell off or to recover has been expectations for a cut, and if they would save the market were it to sell off.
Meanwhile, what you are seeing is this expectation that the Fed will be able to cut rates. We are getting retail sales tomorrow from September, so a little bit stale, but nonetheless some data. We're also going to be getting PPI, a very big focus on Wednesday with the jobless claims. They are early, as well as the beige book afterwards, based on the fact that that is the reference period that a lot of people would be looking to for the jobs report. So a lot of people thinking there will be a greater emphasis on that going forward.
Does it help clear up any of the fog that Chair Powell is driving through? I don't know if it does. It's still not a lot. You can only sort of go on what we've heard from corporate America, from these little bits coming out. Again, we're also going to get delayed retail sales for September, but is that out of touch as we're about to get a big Black Friday spending period?
Coming up, we're going to be speaking with Commerce Secretary Howard Lutnick. That conversation on trade coming at the top of the hour. Also, Ed Yardeni of Yardeni Research, Lorraine Hutchinson of Bank of America, Neil Dutta of Renaissance Macro, and Noor Cristiani of JPMorgan Private Bank. This is Bloomberg Surveillance.
We just don't have a real clear picture of what's happening in the economy.
Economic data has been middling.
The labor side is soft, not yet, weakening in a more scary way.
Consumer sentiment is decidedly negative.
There may be one more rate cut in the books for December.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we see stocks trying to make it day two of some sort of rally. Optimism of a Fed rate cut. We are seeing across the board a sense of calm after a pretty volatile 2 weeks. We do see a sense that even in bond markets, there is a bid with yields down just about 2 basis points, 4.0 0.05%. Meanwhile, crude prices lower yet again after declining almost 4% last week. Crude traded on the NYMEX down now just 0.3%. And this comes as trade talks between the U.S. and the European Union are underway in Europe. The EU sharing it doesn't expect a deal to lower tariffs on steel and other products. Joining us now from Brussels is U.S. Commerce Secretary Lutnick. Secretary Lutnick, thank you so much for being with us. I want to start on your discussions with the European Union. We were hearing some noise that it doesn't necessarily include reducing steel and aluminum tariffs from 50% to 15%. Is that off the table for now?
No, what we're talking about, everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations to be more inviting to our big companies. They tend to tax our big companies and attack our big companies, and they're not getting the investment that we're getting, right? You're seeing trillions of dollars of our tech companies investing in building data centers in America, and they're not getting them here. So we're talking to them about take your foot off the regulatory statement, build those data centers in America, and in exchange for that, we'll come up with a cool steel and aluminum deal that will all be together. So it's all trading. These are trade deals. You're talking about opportunities together. Let's bring it all on the table. Let's see what we can accomplish.
Secretary Lutnick, what's the threshold in terms of reducing certain regulations in Europe on U.S. tech companies that's required in order to create some sort of framework for this deal?
Well, what the European Union does is they say, well, our digital rules, they only touch companies above a certain threshold. Of course, the only companies above those thresholds are all American companies. So come on, that can't be the rule. Let's take it off. Let's settle the outstanding cases against Google and against Microsoft and against Amazon. Let's put them behind us. Let's come up with a reasonable framework where these companies can grow and build. And then those companies will agree to invest hundreds of billions of dollars of data centers here. So the idea is if they take their foot off this regulatory framework and make it more inviting for our companies, they can get the benefit of hundreds of billions, possibly $1 trillion of investment a year. So the idea is I'm trying to convince them that winning the way Donald Trump is winning in America is the way to go. Look at America. Look at these growth rates. Come on. Do you realize our investment in AI CapEx last quarter exceeded consumer spending in America? We had 3.8% GDP growth. We're going to grow over 4%. And next year, we could grow over 5%. You got to embrace what's coming. The AI world is coming. Come on, embrace it. That's what we're here doing, trying to bring and make our deal with Europe, which was a great deal done by Donald Trump. Let's make that deal better.
Secretary Lutnick, just on that point, and point taken on what you see as the benefit to embracing that tech, but the EU over and over again has insisted that its digital laws are not up for discussion. Are you seeing any sort of relenting from them as you've been pushing it? Does it seem like they would agree to you on this point?
Well, I see a lot of ministers. Remember, there's 27 countries, so some are more open-minded than others. But, it's a process, which is talking to them and telling them that if they want to get that kind of investment here, they've got to change the model. So there's the carrot and the stick. If you keep taxing these companies, they're not going to give you the investment. So that's my job, to sort of talk about it, help those American companies find their way clear to invest here and to grow here. And another example for them, I show them that, they're ruling out clean diesel for batteries. And I try to remind them, you don't make batteries in Europe. Come on, guys. Don't make rules that harm yourself. You don't make batteries. That's not a good idea. Stick with clean diesel. Stick with combustion engines. Come on, be clever about yourselves. And just common sense. This is the common sense Trump administration here in Europe trying to remind them that they have an amazing economy that can grow and build, will help them grow and build with great trade with America. But you can't be silly and sort of embrace just batteries, which you don't make in Europe. So these are the kind of conversations I have. They're pretty fun, if you ask me, because I get to point to the growth in America and say, come on, follow our lead, and we will have a bigger, better, stronger trade deal. We'll add to it. We'll add excitement to it, but you've got to come along with us.
Secretary, in terms
that's
of
the model
that big growth we've been
about.
seeing, because the AI has been contributing a lot to this American economy, and as a lot has been said about the two-speed nature of it, that on one hand, AI is doing well, and on the other hand, you have consumers that are still feeling high prices. You saw that play out through the most recent elections. There's been a renewed concentration from this Trump administration to try to reduce tariffs, especially on things like food goods. Are you and the rest of this administration, as you negotiate tariffs, specifically looking at that, trying to find tariffs to bring down to lower the cost of everyday household items for American consumers?
Exactly. The Trump administration is exactly about affordability. We are going through every line item to try to make sure we can drive affordability across the American consumer landscape. Two things, though. American earnings are growing, right? The average earnings of America, their income is growing. So as that grows and we drive prices down, you're going to feel that golden age coming. So it's the combination of earnings growing and we are razor focused on bringing down prices. That's one of the things we're doing here today, working together to try to bring down prices on average daily products. We are working on it. The Trump administration is on it. We have a clear direction from the president. We are going to lower prices
Secretary
and make
Lutnick,
things more affordable.
just to build on what Danny's
we're also going to
talking
raising income as well.
Just to build on what Danny's talking about, though, there is a feeling that there is a limit to how much tariffs can go up or how much the Trump administration may have to reduce tariffs going forward in order to address some concerns about cost of living. Has that affected your negotiations at all?
No, I think it's pretty easy. The world understands that there's give and take in these trade deals, and the benefits are clear that the Trump administration has created the greatest set of trade deals. You know, the president has talked about a $2,000 tariff dividend coming back to the American people. He got the one big beautiful bill, which is going to cut, and there's going to be significant income growth from people next year as that bill comes into play. And we are going to focus on the affordability. You saw coffee and cocoa and bananas and all those kind of things. Those prices came down. You're going to see prices continuously come down, energy prices down. Yeah. You're going to see affordability across the board here. Trump administration is going to win in affordability and income. Two sides of the coin, we're going to win.
Secretary Lutnick, there's been a huge focus, and you've been talking about how U.S. tech has definitely been the bastion of the economic growth over the past couple of years. Has the Trump administration decided whether or not to allow NVIDIA to sell the H200 chips into China? That's been a discussion and something that increasingly people are speculating about.
Well, I've seen that speculation. That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from NVIDIA, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
Secretary Lutnick, theoretically, if the U.S. did lose that court in front of the Supreme Court in terms of IEEPA as justification, how quickly could you roll out that package of additional measures, whether it's Section 301 or Section 232?
I think many of them could come very, very quickly. I don't think most of the big deals, I don't think are in jeopardy. I think the people who did those deals, they don't want their tariffs to go up. They want their auto tariffs. That's durable. That was in a 9-0 at the Supreme Court. You have auto tariffs. You have semiconductors. You have pharmaceuticals. You have steel and aluminum. You have lumber. All of those are durable tariffs. They're not going anywhere. I think our big trade deals are here to stay the way they are now, right? And the others, I think we're going to win the case. But I think it would be relatively straightforward for the president to replace it with other means. But it's not going to be necessary because the president has used IEEPA correctly, and he's going to win that case.
Secretary Lutnick, we know you've got a really busy morning, but before we let you go, has the Supreme Court case influenced any of your discussions at all with trade partners in terms of what the potential limits are to your ability to negotiate or potentially keep some of the ongoing negotiations that have been already struck?
So that's exactly the point. I'm here in Europe. It hasn't come up at all. The fact is, we made a great deal with Europe. They think it's important to them. It's important to us. Right? It includes semiconductors. It includes pharmaceuticals. It includes autos. These are things that are important to the European Union, and they're important. The whole trade deal is important to America. I think this deal stands. I think the question that we are negotiating is how to make the deal bigger, how to make it stronger, how to make it more inclusive, how to bring in these digital Markets Act and try to improve that for digital America, how to maybe do steel and aluminum and how to include that, how to do things bigger and better together between our two great economies. I think they're going to do it standards, make sure they take U.S. autos here and make sure we are working together to extend both the European Union standards and American standards throughout the world. I don't feel that the IEEPA case is here at all. I think the opportunity is for us to grow and do business together. People want to have their trade deals with America, and I think these deals are durable.
U.S. Commerce Secretary Howard Lutnick, thank you so much for your time and good luck over there in Europe. Coming up just shortly, Ed Yardeni of Yardeni Research on the Roaring 20s and how far we are into it. This is Bloomberg Surveillance. Good morning. Welcome back to Bloomberg Surveillance. We are seeing a bit of a lift to equity futures. You are seeing a bit of a bid into bonds. It is the glorious reprisal from what we saw maybe last week, where everything sold off. S&P futures lower by 0.3%. Bonds actually did catch a bid last week. I should correct myself there. And they are continuing to decline. Yields lower now by 2 basis points to 4.05%. Stocks pushing higher to start the shortened holiday week. Yardeni of Yardeni Research sees a continuation of this year's remarkable earnings strength into 2026. He writes, there are some legitimate concerns regarding AI-related companies' accounting practices that call into question the quality of S&P 500 earnings more generally. Ed joins us now for more. Ed, wonderful to see you. Thank you so much for being here. So you have been the one dubbing this period the Roaring '20s, yes. And now you seem to be at least a little bit less positive than some other people. Am I getting that right?
Well, yeah, I think for now the market has had one heck of a move here, and it has been the Roaring 2020s so far. I think we're seeing some profit taking. I think we're seeing some questioning of the AI situation. People have called it an AI bubble, which is great. The more that people worry about that being a bubble, the more that they slowly take some air out of it, the better. The worst case scenario would be kind of like 1999, when just about nobody saw it as a bubble and everybody was very excited about it. So having some caution actually is a positive development.
Can you see the overall S&P 500 continue to mount this kind of double-digit gains that people are expecting without the participation of big tech as the main driver?
Well, I think the answer is it's possible. And we've been waiting for the S&P 493. You got the Magnificent Seven, and then I call them the impressive 493. Nobody's been impressed by them because the Magnificent Seven have kind of hogged all the oxygen in the room. But I think it's time for the 493 to really show off, because they're the ones that are going to benefit from the productivity gains that are available, not just from AI, but from automation, robotics, humanoids, and autonomous driving. All these technologies, they're going to be impacting the productivity of those kind of companies. And so I think that's where the earnings are going to really shine. People have been saying that there's been no earnings outside of the Magnificent Seven when you look at the S&P 500. That's not true at all. The rest of the companies have actually done quite well, just by comparison they have. And so, yeah, I think, the Magnificent Seven are right now selling at a 27 times forward PE. The rest of the market's selling for about 19 to 20 forward PE. I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
Isn't it a problem, though, that part of the thesis of why the rest of the market becomes valuable is because of the contribution of AI and the productivity behind it?
Absolutely.
Doesn't it make everything just incredibly correlated, where you think you've hit out on a name that has nothing to do with AI, but all of a sudden Caterpillar's like, oh, a bunch of our earnings are coming from AI, and now they sell off with the rest of the market?
Look, at the end of the day, I think it's going to be up to quarterly earnings reports. The quarterly earnings reports we've had this year have been phenomenal. I mean, we went into these earnings reports first, second, third quarter with kind of mid-single-digit expectations for the growth rate on a year-over-year basis. Instead, it was double that. I mean, we had 10 to 15%. The third quarter's coming in at 14% on a year-over-year basis, and I think we're going to continue to see that earnings surprises because of the impact of technology and boosting productivity. And yeah, I'm very concerned about the slowdown in payroll employment, but on the other hand, GDP continues to be very strong. So the implication is, and I think we're going to see it in the numbers now that the government's open and they do some collecting of data, I think we're going to see some very powerful productivity numbers.
Can we get back to another set of math that Lisa started this on, this idea of depreciation, depreciating assets within these companies and the costs with it? Yeah. The issue that Michael Burry and you've raised this too, this idea that the life cycle of tech is becoming shorter. Yeah. So these assets are depreciating faster, costs rack up quicker, and it's not something that the companies have accounted for in their own figures.
Correct.
How do you sort of solve that equation?
Well, the companies themselves really don't know. I mean, this is one of the big known unknowns. And that is, how long are these chips going to be valuable? How long are they going to work? Some of the NVIDIA chips are pretty hot, and they kind of self-destruct after a while. But look, I think the important thing to recall is that a couple of years ago, when you looked at the number of data centers in the United States, there were 4,000 of them. In other words, this is not like a new, surge in data centers. And the reason that we're building all these data centers is because we need the capacity. I'm using AI all day as a research assistant. And everybody I talk to is looking to see how they can use AI. But there's lots of other technologies that are being used now to increase productivity because we have to, because there's a shortage of labor for all sorts of different reasons.
So that's one side of it, of how useful is this stuff? Can you get the return on it? The other side, do funding markets remain open for these companies to continue to tap, to do the incredible amount of spending that they're doing? You have seen some nerves there, be it in CDS spreads of Oracle, be it in the ability of private credit players to keep funding it if you have wobbles in their publicly traded stocks. Is that a concern for you, that credit markets don't absorb some of the spending as well as they have been?
It's a concern, but at the same time, I'm glad to see that the markets are disciplining the whole process. I mean, again, the fact that people are so nervous about an AI bubble, the fact that some of these risk spreads for the bonds being issued by those who are trying to raise money for AI, the fact that the market is onto the notion that, let's not overdo it, that's a good thing. That's a discipline on the fact that we might be prone to excess, but maybe the markets will diminish that.
Does that mean that the melt-up risk, which you put at a 30% probability earlier, is a lot lower now?
Yeah, actually, a week ago, I lowered it to 15% because I think the fact that the hype is sort of, let's put it this way, that the air is coming out of the bubble rather than the bubble bursting is, in my mind, a very positive development.
Do you think that the sell-off that we've seen actually gives the Fed more room to cut rates, because there is already that skepticism embedded in that AI trade that goes beyond just, cheap money, let's go into it?
Yeah, well, I've for the past year, I've been opposed to the Fed cutting rates, but they just won't listen to me. Last year, when they cut rates by 100 basis points from September to December, I said, you got to be careful what you're doing here because the bond market may not agree with you. And sure enough, bond yields went up 100 basis points. So did they really lower interest rates when, in fact, the bond yield, which probably matters a lot more than the Fed funds rate, and the same thing seems to be happening now, though, we are down to 4%, but the Fed has already cut twice. And I think a third might rattle the bond vigilantes again.
You think they exist? They still exist?
They're still out there.
They seem pretty dead right now.
Well, they're not the only players. There's certainly central banks, there's the Treasury, there's this new invention, stablecoin, is creating a lot of demand for Treasury bills, and certainly that's an important development. But all I'm saying is, at the end of the day, when we're looking at the 10-year in terms of its relevance to the economy, a lot of it has to do with the mortgage rate. And the mortgage rate really hasn't come down much in the face of what the Fed has done, namely cutting rates by 150 basis points. As a matter of fact, Fed Chair Powell said, hey, look, we've already done 150 basis points. Let's give it a shot here, a chance, before we cut again. But then again, you're getting a mixed message from the Fed officials.
Yeah, and from potentially political influence, although some people would argue about how much that's on the table. Ed Yardeni, would love to see you again sometime soon. Ed Yardeni of Yardeni Research, wonderful to catch up with you. This is Bloomberg Surveillance. We're seeing a bit of a lift to start this week after last week ended on a more positive note after a pretty brutal thrashing, particularly of big tech. What you are seeing today is that lift build as the session grows older. Futures up 0.5%, 66.52. You are seeing a bit of dollar weakness as people gauge what's going on. The euro 115.43. A bid into bonds, yields lower by about 2 basis points, 4.05%. And crude lower. What we are focusing on is also Alphabet, given the fact that we heard that report over the weekend about OpenAI and potentially a catch-up coming from Alphabet with Google's Gemini, really posing, Danny, some significant competition.
Yeah, the information reporting that Gemini has been so positively received that Sam Altman wrote a memo to his staff warning of, in his words, rough vibes, and saying that it could lead to a potential revenue growth collapse to 5%. It's an issue because even if AI is this beacon of hope, if not all companies are going to be benefiting from it, what does it mean with OpenAI's commitments to spend over $1 trillion? If all of a sudden they're thinking, I don't know, maybe we don't spend as much because this is getting more difficult and we're not going to have as many users as we think, that enough could unravel some of the AI trade, even if the promise is there with Gemini, for example.
The weak hands, how much are all of the AI entire ecosystem really leveraged to a couple of hands that could potentially be a lot weaker, considering that they have less revenue, let alone profitability, to really fortify some of those bets? It's the reason why this morning we see Amazon potentially having more data center capacity than people previously believed. There is this feeling of data capacity hoarding in order to prevent your competitors from getting control over it. And how much is that fueling some of the arrangements that we've been seeing?
I love that aspect to it. It also sort of echoes when Meta was hiring every single AI expert that they could, not necessarily because they needed all of them, but almost to say, well, we own all the AI geniuses. Sorry, Apple, you're not getting any of these. It's that sort of arms race, but at what point does it go too far? And that's a question the market has started to address.
I'm going to dress up like an AI genius for Thanksgiving. And meanwhile, on our radar this morning, Treasury Secretary Scott Bessent saying the U.S. is not at risk of a recession in 2026. Bessent acknowledging that some parts of the economy are under stress, including the housing market, and claiming that President Trump's tariffs are not impacting inflation. Elsewhere, New York City Mayor-elect Zohran Mamdani saying he's open to alternatives to increasing taxes on the wealthy to fund his proposals.
I believe that these are two tax proposals that make sense, increasing the personal income taxes on New Yorkers making $1 million or more by just 2%, increasing the top corporate tax rate to match that of New Jersey. More important than how we fund something is that we fund something. And if there are additional or alternate revenue streams to do so, I will accept them and I will celebrate them.
Mamdani's comments coming after his meeting with President Trump at the White House on Friday. And Danny, that was not the meeting a lot of people expected. They were expecting fireworks, pugilistic kind of displays of machismo. But instead, it was a love fest with one person saying, you can call me a fascist. And the other person's like, yeah, I'm a communist. And essentially, we love each other because we're both New York fans.
And it was literally like a get out of jail free card. Like, no, don't answer the question on fascism. And then he does an interview after that, Mamdani, the mayor-elect, saying, yeah, well, Trump said that I called him a fascist. Like, my opinions haven't changed. It's, okay, something we've seen play out. If you go in person to the president, the opinions tend to be different as if you haven't been. But it also underscores the fact that they're both trying to address affordability. They want the American populace to see them tackling it. Of course, they both come from very different sides. Not all of it is coming from different sides. Taxes certainly is one of them. But they have the same goal. So on that front, they had a big agreement.
Yeah, and they both have very strong presences on social media, and this only added to that. Meanwhile, the White House preparing a contingency plan if the Supreme Court strikes down President Trump's sweeping tariff powers. The president posting on social media earlier this morning that the full benefit of his tariff policies would take effect soon. And we spoke with Commerce Secretary Howard Lutnick earlier this morning about some of the ongoing proposals, a real question about how much more is going to go into effect and what could potentially happen should these be overturned.
He really talked about the EU's digital taxes and digital scrutiny, saying that this is the thing that they need to come around to. He seemed positive, saying essentially, look at the wealth of America and how much AI has done for us, and why don't you want that, Europe? They don't want that because this is where they really can have sovereignty. Are there rules around digital companies? I don't think Europe is just going to give that up. Maybe it sees some of the lines being moved if it means they can get relief on tariffs, things like steel that they really want. But again, this is a question of sovereignty for them. It is not something they're just going to cede to the Trump administration.
And it's not a new debate and it's not a new negotiation. Let's turn to the Federal Reserve. Wall Street watching for a slew of data this week, hoping for a signal on future rate policy ahead of the Fed's next meeting. Neil Dutta of Redmac writing, odds for December should be sub 50. That daily is saying December is an open question, means it's probably kaput. No December means no January. Neil joins us now. He is grumpy. He wants the rate cuts. He doesn't see them. Why do you put this off so much, given the fact that New York Fed President John Williams seemed to really open the door to a rate cut next month, and we do have that closeness between him and Fed Chair Jay Powell?
Well, you're doing me not a solid there. I mean, I wrote that before Williams came out.
Let's do this again. Neil Dutta is positive for a December rate cut because of John Williams.
I think the sort of, I think the bigger problem is that we're even debating whether it is or isn't, really, right? I mean, if they don't go in December, maybe they wait for the data. We know that the employment and the inflation numbers come out actually after the Fed meeting, so perhaps they come up with some consensus where they pause, they want to see the data, then they go in January. I mean, that's possible too. But to me, the bigger issue is what's really there to debate? And why are we having this debate? I mean, unemployment has been climbing. It's actually been rising for 3 consecutive months. We were very close to going to 4.5%. Everything that's come out since September, in October, we saw that WAR notices, the worker adjustment retraining notices, rose. We saw layoff announcements rise. So what makes anyone think that unemployment is going to stabilize here? My sense is that it's much easier to tell a story for why unemployment is going up than why inflation is going to reaccelerate. And so the fact that we're having this big debate about whether or not we can go 25 in December or January, to me is a bit ridiculous. I mean, it almost feels like, I don't want to be fatalistic, but it does feel like the train has already kind of left the station. I mean, even if they are able to cobble together a consensus, Lisa, the likelihood is that that's probably going to be it. They're not going to signal a path of easing going forward.
So the train has left the station implies that you see a greater chance of recession. Is that correct?
I do.
So for next year, you see actually a greater chance of recession next year, which is completely counter what we're hearing from every company and every Wall Street strategist, which is often how it happens. But that's what you see.
Yeah, I do. I mean, I think if you go like sort of industry by industry, like what area do you think is going to look better going forward? I mean, with respect to employment, right? I mean, so, I've talked about residential construction. Home builders are sitting on more unsold inventory. So which way do we think residential construction jobs will go? The freight sector is in recession. It's in recession going into the holidays. As capacity comes out of the freight industry, which way do we think trucking and rail and employment is going to go? What about restaurants? I mean, if you pull up a chart of restaurants, I mean, their margins are being squeezed. They're telling us that they're holding the line on price. If their margins are being squeezed, which way do we think employment's going to go for them? Look at lumber prices, oil prices. If you're a sawmill, can you actually make a profit with lumber prices where they are? Probably not. So if you're in the woods product employment, which way do we think that's going? How about people working on oil rigs? Also probably down. So, there's a lot of this sort of myopic fixation on initial jobless claims. And, initial claims have to go up. We haven't seen initial claims. Well, initial claims aren't really a leading indicator, right? They're just an indicator that comes out every week. What we know about how businesses behave is they shut hiring off first. They've done that. And then they lay people off as a last resort. And so if you have to ask me, like, which is the direction of layoffs over the next 6 to 12 months, my argument would be it's probably higher.
This is an economy, though, that defied a lot of the worst expectations for a downturn after COVID, and a lot of it was attributed to the government giving out more stimulus. If we don't get cuts from the Fed, but what we do get is Washington, D.C. handing out $2,000 tariff rebate checks. You get tax rebates, too, from the One Big Beautiful Bill. Could that be enough to save a recession from this economy?
Well, I mean, I've never in my career been able to figure out a way to make tax refunds useful in terms of predicting what happens with consumption, because it doesn't actually change permanent income. That's what ultimately drives consumer spending. So to me, it's probable that people save the refunds that they get because they're worried about job loss, right? So to me, it's that income constraint that matters, that's more binding than whatever people get with the refunds. I don't really have an opinion on $2,000 rebates. Treasury Secretary Bessent has said that they probably need Congress for that. So, the president can say what he wants, but ultimately, to me, this is really about monetary policy being too tight, and that's kind of setting in motion a slowing in the economy.
So then there's a question about the 5 voting speakers we've heard from that don't want cuts. What do they see that you don't? Lisa pointed to one of the possibilities, corporate America is really strong. Another possibility, and this was raised a few weeks ago by Evercore, was that it is FOMC members digging their heels in ahead of what they see as a Trump-appointed chair who will want cuts, and them setting the groundwork now for fighting back against that. Do you think there is some politics to play behind what these officials are saying?
I mean, it's possible, but you take them at their word. I mean, their basic argument seems to be that inflation has been high for a while, and that as a result, that expectations can become unanchored. I really see very little evidence for that. I mean, if you look at business inflation expectations just from the Atlanta Fed released last week, I mean, it's basically where it was last year, even before all the tariffs started going. So if the price setters in the economy don't see higher inflation expectations, it's really challenging to see where it comes from.
Neil, I'm old enough to remember when I was feeling bearish and you were yelling at me, like, things are going so well. What are you talking about? And now I'm saying, companies are doing really well. And you're saying it's not going to work. The train has left the station without rate cuts. When was the last time you were so negative on the state of the economy?
I mean, I'm a pretty young guy, so it's been a while. I mean, probably when I started my career, I worked for someone who was very bearish. So maybe that was the last time, like back in 2006, maybe. But yeah, I mean, look, you can't say I'm a perma anything, right? So yeah, I mean, I think that there's more reasons to be cautious than bullish right now. That's sort of the way I'm looking at it.
Going forward, who do you expect the next Fed chair to be? Evidently, we were supposed to get a pick now, then it was going to be next month, now evidently January. Is there an indication to you, based on the timeline, that keeps getting moved, depending on the moment?
I think the longer the process goes on, the more likely it is that Secretary Bessent becomes the Fed chair. That's my view. I mean, I just think that... what do we know? I mean, we know that President Trump wants Secretary... Could you imagine being one of these other people? Like Kevin Hassett? Like, it's so obvious that you're number two. Because every chance he gets to talk about the Fed chair, he's like, well, I wish this guy over here would do it. And he's pointing to Scott Bessent.
And number one doesn't want it.
Right. And he keeps saying no. I don't know. I mean, to me, it's almost like a bet on, do you think that President Trump gets to make his personnel decisions or not? And if you do, then you have to assume that Secretary Bessent is the one that takes the seat. The longer the process goes on, I think the more likely it is he's the one in that seat.
Neil Dutta, always wonderful to catch up with you. Neil Dutta, a Renaissance macro here, and he is not always bearish, just to be very clear. Usually that's my moniker. And this time around, not feeling very positive. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Billionaire hedge fund manager Bill Ackman is getting ready to seek an IPO for Pershing Square next year. The Financial Times reporting Ackman is speaking with advisors and has informed some investors that a listing may come as soon as the first quarter. Alibaba shares surging in pre-market trading. This after the company said its Kwon AI tool hit 10 million downloads in the first week after becoming publicly available. Alibaba plans to add agentic AI, shopping and other capabilities to the app and launch it overseas. Wicked for Good scoring the second best opening weekend sales of the year. The second film in a two-part series based on the Broadway musical brought in $150 million in ticket sales in its first weekend in U.S. theaters. The spike in ticket sales was welcome relief for theaters, ending a recent box office drought that included the worst Halloween weekend for cinemas in 31 years. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the AI revolution.
There is some AI fatigue.
You cannot get away from the comparisons to the late 1990s.
The narratives will get even scarier, but that's an even greater opportunity to be able to put capital to work.
Nor Cristiani of JPMorgan Private Bank joins us next. This is Bloomberg Surveillance. Coming into a week where we have a lot going on, even though it is a holiday-shortened week. Tomorrow we've got retail sales as well as PPI. On Wednesday we get the Beige Book, which will actually carry greater import due to the dearth of other data, as well as initial jobless claims, which comes at a key survey week. So a lot of people digging into that right now. You are seeing that rally continue to build. 0.5% gain on S&P futures. You are seeing a bid into bonds continue to develop as the session grows older. 10-year yields now down 3 basis points to 4.04%. Crude rebounding. We'll take a look at what's going on with those negotiations between Ukraine and Russia and whether there was something to spur that. Under surveillance this morning, the AI revolution.
There is some AI fatigue.
You cannot get away from the comparisons to the late 1990s.
The narratives will get even scarier, but that's an even greater opportunity to be able to put capital to work.
We don't think AI is a bubble. The technology is not a bubble.
The market is, is still going to keep wanting some kind of proof
Here's the latest. The sustainability of the AI spending boom whipsawing tech stocks as bubble fears reemerge. Noor Cristiani of JPMorgan Private Bank writing this. Simply bringing modernizing energy infrastructure to meet current demand needs would entail trillions of dollars of investments, which means we are a very long way from an energy capex bubble. Noor joins us now. Noor, thank you so much for being with us.
No, thank you for having me.
It's fascinating to take a look not just at the big tech names in the United States, but the ramifications of the entire ecosystem to build out around AI and what opportunities there may be around that. How does Latin America fit into this in a way that you're seeing with both clients as well as just in terms of the international landscape?
I think that you point out a really important thing. So one of the things that we have been discussing the most with clients is that we are still positive on the AI trend theme, that it underlines one of our key pillars in the 2026 outlook that we published only last week. But it goes beyond just the traditional Max 7. And that is something that we want to make sure that our clients see. The ramifications of AI go way beyond just the hyperscalers or a certain set of companies, both in the private and the public space. They also permeate into sectors such as infrastructure or industries such as energy. And in that specific role is that where Latin America comes in. Latin America has an amazing wealth of natural resources. And we have clearly seen it being more and more in the news, given precisely the opportunity not only for these companies, but for countries in general, developed countries, to also leverage some of the opportunities on trading those natural resources with the countries in the region.
And this is clearly something that I'm hearing more from a lot of investors. We're hearing from portfolio managers who are looking to other places. I wonder how much this is complicated by the deal that the U.S. made with Argentina, a question of who's the next Argentina, who is the next region or country that is going to create some sort of alliance with either the U.S. or with China and get some incoming capital.
I don't really know if we can say that it's going to be the next Argentina or not. I think it's the region as a whole. The opportunities that underline the potential for the region are massive. 40% of the world's global copper reserves lie in Latin America. Only Chile itself represents 27% of those resources. Argentina together, number 1 and number 3 in terms of lithium resources. Venezuela has the largest oil reserves in the world. Still, Brazil, for example, is the country with the largest producer in Latin America. Agricultural commodities, everything, silver in Mexico as well and Peru. So any important resource for this transformation, especially on the industrial energy side, lies in Latin America. So it goes beyond just who's the next Argentina. There can be a renaissance for the entire region, especially as we move into greater openness towards private investments, towards developing not only drawing in external or foreign direct investment into a region, but also developing the internal investment sources.
It does feel like there's two sides to this, because one, it's an incredible opportunity, right, for all these precious metals and other industrial metals, which already had uses, now being fueled into a new AI economy. But what does it mean then to find true diversification for portfolios if increasingly different parts of the economy are being fueled by AI?
At the end of the day, the way that we think about, let me take you a step back. The way that we think about internet right now is everything. You cannot do anything without internet. Certainly my children would definitely not survive without their iPads if we went anywhere, right? So I think we are thinking right now about AI sort of in a box. So this is the AI theme. But in reality, it will eventually permeate into every single sector in the economy. So it goes beyond, as I said in the beginning, it goes beyond just thinking about AI in these sort of 4 little walls, and understanding that it is a technology that is going to disrupt every single process of our day-to-day livelihoods, from the way that we get coffee, from the way that we interact with each other, from the way that we do online shopping. So I think that when we understand that, diversification comes naturally into our portfolios. Right now, what we're talking about, and it's part of our outlook again, is how can you leverage this theme through the private side, through the public side, but also expanding into other areas such as barbelling, to some extent, the risk of exploring new ventures on the private side in your portfolio with something in which you have a little bit more visibility, such as infrastructure and real assets.
Have any of the recent high-profile blow-ups in private credit markets, as idiosyncratic as they might be, has that stopped clients, or at least sort of hamstrung some of the interest that clients have had in private assets?
Great question. I don't think that it has hamstrung interest. I think that it's definitely raising doubts. I think that it's definitely raising some question marks over there in the back of their minds. One of the questions that we get the most often is precisely the risks around private credit and all the scandals that we've heard of so far. We don't think that that's the case. On the contrary, we believe that there's value and the opportunity for AI to continue to finance expansion through not only private markets, but public markets as well, is massive. Our colleagues in the investment bank, for example, have called for $5 trillion of spare leverage capacity in markets to finance this expansion, which is exactly the number that we foresee in the next few years for infrastructure developments. So there's definitely some signs of exuberance, but we're not at a point in which that would be our biggest concern now.
How much does the opportunity in Latin America really hinge on the elections that are coming up also? This idea of creating a little bit more fiscal discipline in order to create an investing framework that seems a little bit more reliable.
Latin America has had natural resources forever. Mexico has had the border since it was Mexico, pretty much. So the argument about these being powerful for Latin America could have been the same argument that we were talking about 20, 30, 50 years ago. The juncture in which we're right now, I think that you put the nail on you hit the nail the head.
Nail on the head.
Nail on the head.
I always get everything wrong.
Exactly. No, there you go. So why? Because we're coming into a key election year for the region. And beyond just elections have always been a thing for Latin America and for emerging markets in general. What we are seeing right now is the possibility of the pendulum swinging from the extreme left to maybe something a little bit more center-right, or at least open to private investments. And that could be something that is extremely powerful for the region in catapulting the potential that we see. We've already seen it happen in Bolivia, for example. That was a surprise. We've already seen it happen in Ecuador. We saw it happen as well in Argentina. So those are examples that tell us that there is some openness to this potential that could, together in the mix, finally bring that possibility to fruition.
Cristiani, thank you so much for being with us today. Cristiani of JPMorgan Private Bank. Right now, we're looking at a market that is feeling a lift as people reprise their hopes and dreams of AI. Coming up next hour, we'll speak about that $7,800 price target that so many different investors have for next year's S&P targets. Mike Wilson of Morgan Stanley is one of them. Lorraine Hutchinson also joining us of Bank of America, James Egelhof of BNP Paribas, and Ohsung Kwon of Wells Fargo. This is Bloomberg Surveillance. Good morning.
We don't think AI is a bubble, but we want to now expand our investment universe of how to capitalize on this new technology.
You should stay risk on, but also thinking about which other parts of the market to be dipping into.
We are not hitting a wall. These things happen in a hyper-growth capex cycle.
How do we get a Europe rally? You just get volatility to calm down a little bit.
The narratives will get even scarier, but that's an even greater opportunity to be able to put capital to work.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Futures building on Friday's gains with hopes of a Fed rate cut gaining steam. Traders focusing on the U.S. consumer to power equities higher in 2026 with a key tell in this week's kickoff to holiday shopping plus retail sales out tomorrow from September. The year ahead outlooks are pouring in and there's a clear message. Danny, it is to buy the dip.
It's hard to look at last week and the week before and say that this is anything other than the machines taking over, that it was systematic strategies, just looking at how much the momentum trade was being killed. And I think that's given people a lot of confidence to say, this is a sell-off you want to buy. But market narratives are incredibly important. So it's not only who was doing the selling, but has the narrative changed? Are the gurus and Sam Altman and Mark Zuckerberg, are we going to look at them differently and not take their grand prognostications of where AI goes at face value anymore? Are we becoming more discerning? So sure, maybe we can go higher, but maybe not at the speed that we were.
There's a sense that there needs to be some reconciliation between the AI boom and the rest of the world. The idea that consumers have been feeling the pinch and that the economic data has been coming in, raising questions about the state and the resilience of the U.S. consumer. If you do see a participation with the consumer actually feeling better, how much does that fuel this idea? It's not just AI, but the adopters that are really going to drive this rally higher.
I think that's what you would need to get someone like a Neil Dutta to get on board with the idea that this economy is okay. Because it's fascinating to be able to have this conversation. I mean, we heard it from Secretary Lutnick of how AI is powering this economy. And on the same time, have an economist come on and say, if the Fed doesn't cut, we're going to be in a recession. It is quite remarkable to come away with those two very different views from the very same economy.
Yeah, and just to give you a sense of where we're focused on, and that particular economist is saying the train's already left the station. This week, we are looking for retail sales and PPI tomorrow. We've got the beige book coming out on Wednesday, as well as jobless claims. Look out for that. Right now, you are seeing that lift continue in markets after last week really ended with a more positive note, yet still down about 3% for the NASDAQ this morning, up 0.6% on S&P futures, building on gains at session highs. You are seeing a bid into bonds, although we're tracing some of the earlier fervor, 4.05%. And crude has rebounded after being lower earlier in the session. Coming up this hour, Mike Wilson of Morgan Stanley with stocks edging higher. Lorraine Hutchinson of Bank of America on the state of the consumer heading into the holiday shopping season. And James Egelhof of BNP Paribas as traders await the release of key economic data, albeit highly stale. We begin this hour with stocks eyeing a rebound as we head into that shortened Thanksgiving trading weekend. The team at Morgan Stanley releasing their outlook for 2026, writing, "We raise our S&P 500 price target to 7,800, driven by strong earnings growth. We believe that we're in the midst of a new bull market and earnings cycle, especially for many of the lagging areas." Mike Wilson of Morgan Stanley joins now. Wonderful to see you, Mike.
Thanks, Lisa.
So let's start on the optimism. You have been optimistic for quite a while, talking about the rotation into the adopters, not just the AI tech behemoths. Why are you getting even more optimistic as the year goes on?
Well, I would say it's just a changing, it's an evolving narrative we've had, which is that we think that, the policy is still misunderstood, right? That they essentially came in this year, did the growth negative stuff first, and now we're looking at the growth positive stuff. I'm not worried about the economy. What I am a little bit worried about is that the Fed is kind of dragging its feet. So I would agree with Neil's comment, like the Fed needs to cut, but not to save the economy, but to see the full rotation into these lagging parts of the market, the interest rate sensitive parts of the market, which is really our story for 2028 or 2026. We think that 7,800 is dependent on the earnings cycle broadening out.
So there's a lot to unpack there. I want to start with you agreeing with Neil, because Neil had a pretty negative assessment of the overall economy, saying he suspects the train's already left the station with respect to the pain from the Fed keeping rates where they are for as long as they have, and that we could be looking at a recession. You seem to disagree on that. So where's the nuance here? What's the difference between preventing recession and really allowing the rotation into some of these other names?
Yeah, I mean, I think our view has been differentiated, that we think we have had a recession. We went through a rolling recession in the private economy. So I would agree with Neil that the economy is weak, but it's rebalancing now towards the private economy. I mean, many parts of the economy have been suffering: housing, all the interest rates, durable goods, consumer goods, which have been under pressure, commodity sectors, transportation. There's been no volume going through the economy, no velocity in the real economy. And the way that the administration is changing the policy, in addition to the Fed now cutting hopefully next year, you'll see the private economy now doing much better, the government no longer crowding out these areas that have been under pressure. But we do need to get that trend, that the Fed needs to do more. The Fed needs to cut rates, and they need to probably provide some balance sheet.
I'd say one of the things that Neil talked about was his fear that even if they cut in December, they're not going to lay out a path for continuous cuts. And Fed Governor Waller seemingly enforcing that, speaking on Fox moments ago, saying you might see more of a meeting-by-meeting approach once you get to January. If you do get that posturing from the Fed that maybe they cut in December, but it's a meeting-by-meeting approach, they're not necessarily going to cut in every single one, is that enough to allow for that rotation, or do you need a clear path of cuts to get it?
No, we need the latter. And I think we're going to get there one of two ways. Either the data, the labor data is going to basically support our view, or my view, that we had a rate of change trough in the labor markets in April. Okay, and so that data then will allow the Fed to cut more, or signal they're going to cut more. The second one is that we get more financial stress. Okay, that's what's been going on. We think the market, we wrote about this back in September, early October. We thought the market was going to have a 10 to 15% correction because the liquidity wasn't there, that the balance sheet was tightening. And we think there's evidence that correction is well advanced. Okay, all the momentum stocks Crypto obviously is the topic of the day, down 30% for Bitcoin. I mean, these things are telling you that the market is worried about this liquidity. So as usual, the markets will dictate the Fed's timing. So if the market really wants, and look, markets are like children, right? They'll have a little temper tantrum, and then the Fed will respond to that. So there's this like a mini 2018 in that regard, right? You kind of go into end of the year, and then there's stress in some of these financial metrics that the Fed cares about, and then they provide more balance sheets. So we think there's a sort of this tug of war going back and forth, but ultimately it resolves in a more dovish policy path.
On the point of crypto, a lot was made, even from Bill Ackman basically saying things that he thought weren't correlated all of a sudden were, that Fannie and Freddie were selling off because the people who were buying crypto were the same people in those names. Did last week and the week before's episode, given how much crypto falls, show some vulnerability within the market structure, within who owns these stocks and how fragile and weak some of those hands are?
I don't think it's showing anything new. I think this has been there whole time, right? I mean, people waking up to the idea that liquidity is important for the market. I mean, obviously, I don't know what they're doing. I mean, that's kind of crazy. I mean, of course, liquidity matters. I mean, liquidity is, and especially the last 10 years or so. I think that the hard part about liquidity is it's sort of this sort of nebulous thing. It's hard to measure. And I've spent a lot, like the last 2 or 3 years, trying to develop a better skill set around that, and I think we've got a better handle. But I would say it still is one of these things that's sort of the invisible hand. And so what you have to do is you have to look at the market to tell you when liquidity is tight or not.
So you kept mentioning the balance sheet. Are you saying QE is going to start again?
Well, they may not call it QE, but yeah, the balance sheet needs to expand, not only to support financial markets, but to support the better growth that I think is coming next year, right? So if CapEx really picks up for the first time in 10 years, okay, let's be honest, we haven't seen much capital spending, but the big beautiful bill is incenting that. That's a usage of capital that needs to be supplied by somebody. So the balance sheet needs to grow just to help the economy and the markets. And so we can call it QE, call it not QE, but generally they need to expand that.
How much is the 7,800 target predicated on the idea of the Fed cutting rates and using its balance sheet to help support liquidity?
It's very important. I mean, I would say if we don't get at least one of those items surprising the markets, meaning more than 3 cuts, or we get more balance sheet expansion, call it QE, call it something else, okay, yield curve control, whatever you want to call it. Okay, if we don't get some combination of that, then we're not going to reach our target. So I'm assuming that we get there either through the labor data or through some financial stress.
So it has been so far that the AI trade has maintained any kind of equity valuation, despite the fact that people are getting increasingly worried about an economy that you think already has gone through recession. I just wonder, do you think that ship sailed in terms of AI leadership propping things up? Do you think that if we don't get the real economy reaccelerating, you cannot get the multiples that we currently have been seeing on the big tech names?
Yeah, I think it's one and the same. I mean, obviously the investment in AI is on the premise that it will lead to higher productivity, adoption, and all of that works. I mean, that's the way technology investment works. So you're not going to, these stocks are not going to work. The leaders aren't going to work if the foundation itself isn't being supported by the technology investment. We assume that is going to happen in 2026. That is part of our thesis. Okay, but it's not without risk. So our job is to lay out our narrative, which we have conviction in, but then to highlight these risks in the short term or in the medium term that could throw that narrative off.
Ed Yardeni also joined us earlier, just saying that some of the air is being taken out of the AI bubble, and to him that meant that the melt-up that we've been seeing is going to be harder to come by. Has something changed, at least with that blind willingness to continue to buy AI-related stocks, regardless of how much they're spending and what the return on that spend is?
Well, I mean, this is a natural evolution of any capital spending cycle. There's always going to be a challenge on the return you're going to get. And this is, we've seen this multiple times. We saw it a year ago. We've talked about this, multiple times. In July of 2024, that was the peak in sort of an AI CapEx deceleration. So this is an ebb and flow. What I like to look at is the AI spenders. How are those stocks reacting? Is the market enforcing discipline on the AI spenders, which then trickles down into the CapEx beneficiaries? But we think this is going to happen. I mean, the money's been raised now, so like the debt markets are now involved, and so that money's not going to sit on these balance sheets. It's going to be spent. The question is, what's the payoff look like, and what's the timing of that payoff? We think we'll see some of that in 2026, 2027. And so now it's just this transition. You're kind of trading back and forth. So I want to make it clear, we think there's a broadening out. That doesn't mean that all the AI stuff gets killed and everything else does really, really well. It can work in harmony. In fact, it needs to work in harmony to some degree.
If you do get a scenario, though, where, let's say, I don't know, Meta, that seems to be one of the poster children for not getting that return, doesn't get it as much, and they need to pull back on their spending, but everybody else is still spending. Do you only need one pillar to fall to really hurt this trade? Or can just any sort of spending happening within this trade, regardless of who the winner is, continue to lift all the boats?
Well, look what's been going on, right? So we've seen a massive bifurcation or dispersion in the performance of not only the hyperscalers, but names within that. To me, that's healthy. That's like, not everybody's going to win. Okay? There's no trophies here. I mean, you have to actually win the game. But all of these companies are competing for the trophy. So in that competition, I think we continue to see this velocity of spend. And then we're going to see the most exciting part about this AI spend to me is we don't even know yet, okay, these new businesses that are going to be created, these new industries that are going to be created, the efficiencies we're going to get in areas like healthcare or education or manufacturing. That's on the come. That's where the real wealth creation is going to be coming from.
So next year, or maybe the end of this year, when we find out who the next Fed chair is going to be, how much will that matter to you in terms of whether your bull case will get realized? I mean, who will necessarily be good for that and who might be a little more problematic for that?
You're probably not going to like my answer, but it doesn't matter to me because ultimately the market's going to tell the Fed what to do. I mean, that's always been my view. People hate it, but I'm a markets person, okay? The market's dominant. The markets tell investors what to do, right? So the markets will kind of force their hand. If the markets believe they need more liquidity, they will force the Fed's hand. If the market believes it needs more rate cuts, it will force their hand because we become so financialized at this point, right? The Fed now is basically obligated to make sure that we have financial stability to some degree. And they have an obligation to help Treasury fund the government. So I don't believe the Fed is independent. I believe they're trying to work, in the best interest of Americans. Okay, I'm not saying they're dictated by the White House. But they are not independent of the markets. They are not independent of the funding requirements of the U.S. government. Okay, so the Treasury and the Fed will work together to do the best they can to solve those issues.
Mike Wilson, wonderful to speak with you. Mike Wilson of Morgan Stanley, have a wonderful Thanksgiving, and thank you for being here. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Boston Fed President Susan Collins saying she hasn't made up her mind on how she'll vote at central bank's next policy meeting. Collins saying she would like to see more data before making a call. Some on the Fed are preparing for an unusual level of disagreement at the meeting. Fed Governor Chris Waller saying you might see the least groupthink you've seen in a long time. The next Fed rate decision is on December 10th. Meanwhile, the former president of Brazil, Jair Bolsonaro, has been arrested after a judge deemed a flight risk. Police detained Bolsonaro after he took a soldering iron to a court-mandated ankle monitor. It sparked fears that he planned to flee. And in sports, the New England Patriots won their 9th straight game, beating the Cincinnati Bengals to move into the AFC's top seed. Elsewhere, the Baltimore Ravens moved into first place in the AFC North after beating the Jets and the Pittsburgh Steelers loss into Chicago. In the NFC, the Eagles lost to Dallas and the Rams won their 6th straight game over the skidding Buccaneers. And that is your Bloomberg brief. Up next, the morning calls, plus Lorraine Hutchinson of Bank of America with a consumer check ahead of the holiday. That next, you're watching Bloomberg Surveillance.
The average earnings of America, their income is growing. So as that grows and we drive prices down, you're going to feel that golden age coming. You're going to see affordability across the board here. Trump administration is going to win in affordability and income, two sides of the coin.
That was U.S. Commerce Secretary Howard Lutnick earlier this morning from Europe as he negotiated some sort of trade agreement that called for loosening some of the tariffs on steel and aluminum for Europe in response to or in return for maybe lightening up some of the regulations around U.S. tech. Right now in markets, you do see that rebound continuing to gain steam. 0.7% gain on S&P futures session highs. You are seeing that bid into treasuries wane as you do see that risk on field take hold, almost flat on the 10-year, 4.05%. Time now for the morning calls. First up, Wolfe Research upgrading Morgan Stanley to outperform, citing accelerating revenues and attractive valuation. Next up, JPMorgan initiating Hyatt with an overweight rating. saying the company has the potential to close a valuation gap with Marriott and Hilton. And finally, BNP Paribas Exane rating Meta new outperform, noting its ability to aggressively invest in artificial intelligence. Let's turn to retail. The strength of Black Friday shopping this week set to provide a key reading on consumer health. BofA senior retail analyst Lorraine Hutchinson joins us now. Lorraine, thank you so much for being with us. What are you expecting? What are you hearing in the initial phases as everybody heads to the stores, or should I say heads to their keyboards?
Sure. Yeah. Good morning. It's go time today, right? We're kicking off the holiday season with, we call it Black Friday week. If you check your inbox this morning, there's a ton of deals. So everybody is looking for value right now. And I think the key for this holiday season for the retailers is many of them have raised prices. So you'll still get great deals on Black Friday, Cyber Monday, but those deals will be based on a higher price. And the culprit, of course, is tariffs.
How are inventory levels heading into this? Is there excess inventory that they're trying to work through with these Black Friday sales?
Not really, no. I mean, once Liberation Day hit, they all took a more cautious stance on units. The reason is because they know they have to charge higher prices to offset the tariffs. So inventory is actually quite healthy. Black Friday is all about trying to attract customers with holiday deals. So I feel really comfortable with the way inventory is shaping up into holiday. I think the real question will be, what does the consumer do with these higher prices? Will they accept them? Will they look for cheaper options? How much will they spend this Christmas?
Well, it's a good point because, sure, deals, but to your point, from a higher level. What is your read on the consumer, whether they are still going to play up or pay up for those, or if this is just a period of a lot of bargain shopping and only a few will win?
You know, Black Friday is always a period of a lot of bargain shopping, so you will get the real bargain hunters in there. One thing that I can say pretty clearly about Christmas is Santa always comes. We always see a lot of maybe even extra or above plan spending during holiday. So I worry a little bit less about the Christmas gift shopping, and I worry a bit more about self-purchase, right? If you do want to get that must-have item for your kids, you may not buy a new holiday outfit for yourself. So I think there are going to be trade-offs with these higher prices, and I think consumers are looking for the best value, and that doesn't always mean the lowest price. It means where can they get something that's really high quality or a really hot brand for the best deal.
How difficult is it to really get a gauge when you look at overall retail sales? And we're going to get the retail sales number for September, and I understand it's stale data, et cetera, et cetera. How hard is it, though, to get a clean read given the fact that there is an inflationary component of this? That retail sales look good on a headline number, but might actually be really negative when it comes to just the inflation aspect. In other words, most of it is higher simply because prices are that much higher.
It's we think that is the case. If you look at our BAC proprietary debit and credit card data, it would tell you that a lot of the growth in consumer spending is coming from higher prices. So we don't really see a lot of unit growth, and that's why I think the lean inventory levels are important in my sector specifically, because they have been pretty cautious about the number of things they'll sell, knowing that they do need to charge higher prices.
How much are you seeing a lot of retailers cater increasingly to upper income consumers, just because that's where the money is and that's where the consistent stream has been? And we see that from Gap with the idea of leaning into a higher price point in certain parts of their business, which has helped support their business. You see that even at Walmart, increasingly focus on higher and middle income consumers and not just the low end. Is this the new strategy?
Absolutely, and there's no way where you see it more. I'm going to surprise you when I say this, but off-price, TJ Maxx, Ross stores, their comps are surging. If you look at the numbers they put up last week, who would expect TJX to put up a 6 at their core concept or Ross to put up a 7? They are starting to cater to a slightly higher income customer by getting better brands, but at great discounts. So if you can get that treasure hunt really going, a slightly higher end consumer will come in and elevate your prices sold across the store. And that's what's happening with off-price. It's actually a really exciting place to be right now, because with those higher prices come better margins for the off-pricers.
I thought a lot of these brands, though, don't want to be in these types of locations because you get more saturation. It's bad for the things they sell at wholesale. So how are these off-price retailers able to do this and able to bring in a strategy that appeals to higher income people and getting brands that are willing to do that with them?
A lot of times it's fixing mistakes. Nobody's perfect. There are certain styles or certain sizes that they can't sell. and off-price does it very efficiently. One of the reasons why there's not a big online business for off-price is because you can't search it, right? It's a little bit of a secret from some of the higher-end brands, and then some of the higher-end brands just need the volumes and the throughput associated with off-price. They're opening stores, they're growing traffic. They're some of the few retail concepts with strong brick-and-mortar sales growth.
Something about it feels a little bit depressing because it's already a K-shaped economy. And then you have these retailers who were exposed to lower income, increasingly trying to become less exposed to them. What about retailers catering towards lower income people? Do they still even exist anymore, and how are they behaving right now?
Well, they do, and I guess don't get me wrong, off-price is not abandoning their lower income consumer. I think one thing that's very clear is they are trying to service the customer really well at the good, better, and best price points. So what they're also doing is trying to elevate the value that you get at a good price point. So it's actually a great shopping environment for the consumer, but I think also what you've seen, the numbers out of Walmart last week were also excellent, and things like fashion stood out, right? So I think everybody's trying to get a little bit better and provide a better product for same price or more of a value price point.
Lorraine, does anyone actually go to the store, or is everyone just in front of their computer or on their phones? I mean, honestly, does anyone actually do the lining up and running in and pushing people down? Please don't do that. But, is that sort of still a thing, or not really?
Not as much. I mean, Black Friday, over COVID, actually, they all started matching the Black Friday deals online to avoid the crowds, and then it sort of lost its luster. So people do go. But they don't have to be there at 5 a.m. when the doors open. And I think that creates kind of a nicer environment for everybody.
I would think so, but maybe that's like people's recreational activity after eating so much.
Over like poor people trying to get in there, stampedes. I hope that's not their recreation.
The beginning of my career.
I like that it's like instead of a turkey trot, you storm Walmart.
Lorraine Hutchinson of Bank of America, thank you so much for being with us. I guess it is exercise if you're pushing people out of the way, running in. Coming up, James Egelhof of BNP Paribas. Traders await the release of key economic data this week. Plus, we'll check in on some of your morning movers. Oscar Health soaring on reports of a potential plan to extend Obamacare subsidies. That news broken earlier this morning from Politico. This is Bloomberg Surveillance. We are 1 hour away from the cash open, and what we are seeing in markets is that lift continuing to grind into the open. Just about an hour to go, and now we are up 0.7% on the S&P. NASDAQ higher by even more as people pile back into some of the trades they abandoned over the past few weeks. We are also seeing that haven bid into treasuries fade as the session grows older, nearly flat now, 4.06%, even though we did get commentary from New York Fed President John Williams talking about how he could see the near term maybe cutting rates, meaning maybe next month. At least that's how it was interpreted by markets. We are seeing some other things move. Your morning movers include, of course, Alphabet shares, which we were talking about earlier. I am very focused on Alphabet, given the fact that we heard from the information, the fact that maybe OpenAI was losing some clout to Alphabet based on their Gemini model, given the fact that their AI tools are turning out to be nearly as good as OpenAI. Those shares higher by 4.2%.
So nearly as good, if not better, because Sam Altman saying that the vibes were rough because of how good Gemini was, and it meant that their revenue wouldn't be as strong as they expected. It fights against this model that the stock market has been pricing in, where everybody is a winner. Maybe it's a winner takes all. And what happens in that case? Is OpenAI still going to spend $1.4 trillion going forward? Is Sam Altman still the guru and you're going to buy and trade based on whether he says that super intelligence is coming? It's a market that's more discerning because it's an environment that is more discerning, that not everybody is doing as well as the others.
Yeah, and does cash flow matter, right? I mean, the idea that OpenAI is not making money and the idea that Alphabet has a steady, very profitable machine underway, how much does that give them the upper hand to really develop what they want to, get the data centers they want to, and not have to rely on the debt market to be nice to them, and frankly, on everybody under the sun to give them money, give give them handouts, give them shares, give them chips, and whatever else so that they can grow into their dreams.
It's so true, because the question is increasingly turning to, will debt markets fund this going forward? Because so much of this company spending has been pushed to the debt markets. What happens if you get a Fed that doesn't cut as much and allow easy conditions? You have private capital players who are starting to get under scrutiny from their shareholders and maybe don't raise as much or maybe don't take as much risk. And when you start to see spreads widen out, we haven't seen that play out yet. If it is playing out, it's ever so slightly, but does it change the whole calculus if they can't turn to the debt markets as much as they had?
Yeah, meanwhile, we did get some earnings, or particularly a release from Novo Nordisk earlier this morning, talking about Alzheimer's and a trial that they had tied to their Ozempic release. It didn't actually solve Alzheimer's, and you're seeing Novo Nordisk shares lower by almost 11%. The early trials not showing success. Eli Lilly down almost 1%. Eli Lilly also has an Alzheimer's drug, although this really is centered around what the other uses are of some of these weight loss drugs. They cure addiction, they cure overweight, they cure heart disease. The question around Alzheimer's, yet another benefit, but perhaps some of these studies throwing some shade on that.
And I also think this is where Novo was hoping that it had the lead, because it has been falling behind to Lilly. You can see that reflected in the share price. You can see that reflected in the effectiveness of their medicine. So for Novo, this could have been something that would have given them the edge. It's been taken away from them, and that's why you're seeing Novo react so much more than the share price of Eli Lilly.
Meanwhile, Oscar Health shares climbing in pre-market after Politico reported that potentially the Trump administration is considering extending the Obamacare subsidies, the premium subsidies, for 2 years. The caveat being they reduce some of the applied pool of people who are eligible for these benefits. We're seeing these shares up almost 23%. We'll keep you posted on that story as it does develop. Turning to the economy, investors preparing for a key week of data. Bloomberg's Enda Curran joins us now. Enda, the stale September data that we're getting tomorrow, how excited are you?
Well, it's all we have to go on, so pretty excited for now, Lisa. But as you mentioned, the September retail sales data will come out tomorrow. Expected to show a moderation in consumer spending in that month, maybe around a 0.4% gain from a month earlier compared to a 0.6% gain in that month of August. You know, we're getting mixed messages on in retail spending at the moment. Big retail chains are saying customers are spending well. They're broadly speaking saying money continues to tick into their tills. But obviously we're also getting pockets of warnings from some retailers. We had that consumer sentiment, that big dive in consumer confidence in the sentiment index last week. And of course we have economists debating just how real the retail spending story is. Is it really being driven by higher income earners, lower and moderate income earners spending much less, much more worried about jobs, job security and inflation and high prices and the like. So it's mixed signals, but the point of tomorrow's data for September is expected to show that, broadly speaking, on an aggregate level, consumer spending remains robust.
And can you just give us a sense of what we're hearing from additional Fed speak in terms of whether John Williams truly was the base of the committee and the idea that a December rate cut very much still is on the table?
Very divided interpretation on that, Lisa, as you say. I mean, on the one hand, you have a camp making the point that, look, this was a quasi-signal from the leadership of the Federal Reserve that at the very least a rate cut is on the table in a serious way in December. You know, the president of New York Fed is a permanent voter, seen as part of the top leadership. As of right now, as far as I know, the Fed chair is not due to speak, for example. So people are saying maybe this was the proxy for what the head of the Fed is thinking about a rate cut in December. But of course, there are lots of others who also make the point, Lisa, that, hang on, you know, it's clearly a very divided committee right now. We know there's a significant group who are more worried about inflation than jobs. We're not going to get new jobs or inflation numbers ahead of that Fed meeting in December. So that side argues, broadly speaking, there's a case for staying on hold and maybe seeing where things are in January. So I'd have to say it's a very, very divided, very mixed interpretation on it. Lisa, there's a classic read that this was an important signal from the Fed, but plenty of Fed watchers aren't looking at it that way at the moment.
Enda Curran, thank you so much for being with us. Sticking with the Fed, James Egelhof of BNP Paribas writing, we maintain our call for a Fed rate cut in December as we think the rising unemployment rate should ease concerns about inadvertently overheating the labor market over the short run. James joins us now. James, how hard was it to maintain that call after we heard from John Williams on Friday?
Well, it's great to be here. It's certainly a much more rowdy and disorderly process from the Fed than what we're accustomed to. We're having to count votes, which is something we're not accustomed to doing with the Fed. At the same time, we think that Powell wants to keep cutting. We think he has the votes to do that. And we think the data that we got last week is giving a little bit of cover to him to deliver one last rate cut to protect the labor market from some gradual deterioration and to protect the Fed from a resurgence in this political tension they've had between them and the White House. We think that Powell prefers to do that. Now, there are risks that are increasingly appearing that the economy might pick up speed next year. And if the Fed continues to cut rates, it might find itself wrong-footed going into that. We think that's a risk that the hawks on the committee are increasingly vocal about. But there's enough room in this data release, in our view, to keep going one more time.
Can we just play out that scenario? If we do get a reacceleration, that suggests that cuts would be an issue because maybe it reaccelerates inflation. And that happens at the time that you have a new Fed chair put in, regardless of who it is, Hassett, Waller, maybe even Bessent himself, who is pounding the drum for more cuts. How does that play out?
So look, when we think about next year, we take President Trump seriously, and literally we put his economic plan into our baseline. It's why we were so early to expect tariffs and tight immigration policy. He's increasingly talking about fiscal stimulus, about sending people checks to help them with the cost of living through the middle of next year. So for us, it's a really close call about whether we should put those in our forecast. If that happens, and it's big, and President Trump tends to do things big, you could easily see a pickup in growth, a pickup in inflation, and a pickup in hiring. And if that happened and the Fed had moved to a stimulative stance, which is what they seem to be on course to unless they pull back, that could leave the Fed in the wrong, having to take back the cuts that they've already delivered. And that would be a very messy process politically and for the market. And having that happen at the same time as the Fed chair transition would be very difficult for them.
Does that also mean it's your assumption, and kind of given your first answer, if we're counting votes now, is it your assumption that this era of consensus building led by a Fed chair, that's effectively over?
Well, we don't know. But I think we're increasingly moving to an era where the Fed is more divided internally, where there are a lot of different perspectives. Ultimately, if the data breaks either way, so if we get clarity from the data that the economy is reaccelerating, or that it's slowing more in a more nonlinear way, we think that unity would be reestablished very quickly, and the Fed could move with great decisiveness, one direction or the other. But right now, with so much ambiguity in the data, and with the data coming in with such a long lag due to the shutdown, there's a lot of room for different interpretations, and that's what's feeding into this environment that we're in right now.
Neil Dutta of Renaissance Macro was on earlier, and he said that he's really worried that the Fed's already missed the train and that actually the U.S. consumer is weakening quite considerably. That's what they're telling you in their sentiment. That's what you're seeing when it comes to home sales, when it comes to certain auto loan performances. What do you make of that? Do you think that there's some validity in that?
Well, I love Neil's work. I think when we look at the consumer over the past year or two, the consumer tells us that they're depressed, but then they keep spending. And so ultimately, we're reasonably confident with where consumer spending is. We're on consensus for tomorrow's retail sales print. When we look at the labor market, which ultimately is where everything comes from for the consumer, we think the labor market is cruising at a comfortable cruising altitude. All the signs we look at are pointing green there. So we continue to look for resilience in the consumer that could be backstopped with fiscal spending, and that's continuing to be backstopped by strong equity market gains.
You know, people might be saying that they feel terrible and not spending, but the people who feel pretty good are the people who are wealthier and they keep spending. And so there's this question of how much the wealthier cohorts of the economy are continuing to spend because of the stock market. In other words, the sort of closer tie for the stock market and the economy than traditionally is the case, just simply because that upper echelon of income earners has been the one that has been supporting all of the consumption that we have seen so far. Do you think that there is a greater connection right now for the stock market continuing to go up and the U.S. economy continuing to gain, despite the fact that there are a lot of people that are being left behind?
Look, we think that K-shaped dynamic that you're referring to is part of the story for the U.S., that the high-end consumer, buoyed by gains in NVIDIA and other high-flying tech names, that they're continuing to spend. The lower income consumer that's more reliant on their labor income is more anxious, is pulling back a bit. We do think that if you were to see the equity market correct, which is not our base case view, we think that could be recessionary for the U.S. economy, and the Fed would react with great aggression in that scenario. Again, not our base case, but we do think the economy is more keyed to the AI theme than it has been to tech in the past, and that the Fed would have to respond to that.
So just to be clear, a Fed put would very much so be in play in this scenario.
Well, I mean, I don't think the Fed is necessarily there to protect you in your equity investments, but the Fed is there to protect the economy. So I think the Fed would readily read through to the idea that if you were to see a big decline in the equity market, that the consumer could pull back and that may mean that there's more room for rate cuts. So we think that that read across would be straightforward.
Well, on the other side of things, of concern about financial conditions being too loose, it's hard to look at the spending the hyperscalers have been able to push through this bond market and argue that these are very tight financial conditions. How do you think the Fed sees that in this economy that's increasingly being geared to AI players and the spending that they're doing?
So look, we think AI has kept the economy out of recession this year. It's not just about the AI capex, it's also about the consumer, as we discussed, and it's about broader business sentiment, where businesses expect a big productivity boom just over the horizon coming from AI being commercialized and applied more broadly in the economy. And this is something that came up in the Fed minutes last week, that if there was to be a moment of disillusionment about AI from whatever source, that could have fairly large and quick effects on the economy. So we think that they're starting to take note of this. It was in the minutes. Powell's talked about it a few times at the press conferences. And as far as we're concerned, for the moment, steady as we go. But if there was to be a bump along the road in the AI transition, we think the Fed would take note of that very quickly.
So just going forward, we do get retail sales as well as PPI tomorrow. A lot of people are saying it's not going to really tip the needle, considering it's old. At the same time, we do get jobless claims. We do get the Beige Book on Wednesday. And then fast forwarding, we get things like the JOLT survey as well as ADP. Which data points do you think are going to be most instrumental for the Fed heading into their December 10th meeting?
You're not going to like my answer, but really none of them are going to be all that helpful. They're all old. They're all second-order data. The data that I think Powell was hoping would resolve the debate on further easing was payrolls last week. It could be read both ways. We have a gradually rising unemployment rate that suggests that there might be a little bit more room for easing. But then headline job gains came in quite strong. That's just the economy is doing great, and the argument that the labor market's at stall speed is not panning out. So this data is not going to resolve the tensions and the disagreement at the Fed. It's going to be a rowdy and disorderly debate all the way through the end. Ultimately, we think it's Powell's call. I think he has the votes to go either way, and the data is not going to ultimately make everyone move to the same page.
In other words, if you're looking for clarity, keep looking. James Egelhof of BNP Paribas, thank you so much for being with us today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Treasury Secretary Scott Bessent saying the Trump administration is planning a health care announcement this week. Bessent urging Republicans to come up with a plan by January 30th to address health insurance premiums. The premiums are set to spike when subsidies expire at the end of the year. President Donald Trump is pushing back on the possibility of television networks being allowed to expand, responding to a Newsmax report that the FCC is considering a merger of Nexstar Media and Tegna. Trump writing on social media, if this would also allow the radical left networks to enlarge, I would not be happy. ABC and NBC in particular are a disaster, a virtual arm of the Democrat Party. Meanwhile, Harvard is confirming it's the latest victim in a string of Ivy League cyber attacks. Following similar breaches at Princeton and Penn, a database containing alumni and donor contact and donation details was accessed via a phishing scam. The university has since locked down its system and is working with law enforcement. That is your Bloomberg Brief. Up next, setting you up for the day ahead, plus Ohsung Kwon of Wells Fargo with a bullish outlook on equities heading into the new year. Hint, it sounds like the figure that we heard from Mike Wilson as well. This is Bloomberg Surveillance.
I'm not worried about the economy. What I am a little bit worried about is that the Fed is kind of dragging its feet. The Fed needs to cut, but not to save the economy, but to see the full rotation into these lagging parts of the market, the interest rate sensitive parts of the market. We think the 7,800 is dependent on the earnings cycle broadening out.
That was Mike Wilson of Morgan Stanley talking about a 7,800 call on the S&P 500 for the end of next year, and talking about how it is predicated on the idea of Fed rate cuts and responding to a lack of liquidity potentially with the Fed's balance sheet. Counting down to the opening bell, what we do see right now in markets is a lift to equities pretty much across the board. You can see that particularly outperforming with the NASDAQ 100 futures up 0.9%. The Russell getting a bid as well, up 0.3%. Meanwhile, what you could see in bonds is a little bit of the bid to safety, the Haven rally fading just a touch, some pushback to the idea that John Williams was signaling a December rate cut. And you are seeing yields marginally higher on the front end. 2-year yields up just a basis point to 351. A rally into the long end, though, with 30-year yields at 4.69%. Here is the trading diary for the week ahead at 4 p.m. Eastern. President Donald Trump signing an executive order. Tuesday, PPI and retail sales. Wednesday, another round of jobless claims, durable goods. And the Federal Reserve releases its beige book. Fascinating reading. Do it. Thursday, U.S. markets are closed for Thanksgiving. Finally, Black Friday, the unofficial start of the holiday shopping season, kicks off. Turning back to markets, Ohsung Kwon of Wells Fargo is looking ahead to next year, expecting the S&P 500 to reach, guess what, 7,800 by year-end 2026, writing, valuation is rich, but it's only half the equation. The other half is EPS growth. Ohsung joins us now. Thank you so much for being with us. And it's going to be a really interesting period into year end. You talk about 7,800. You have a slightly different take than what Mike Wilson was talking about. How much is this predicated on a rotation out of the Magnificent Seven into the rest of the universe? How much is this predicated on overall earnings per share growth?
Yeah, so I think 2026 is going to be a year of two halves. I think the first half of the year is going to be reflation. We call it the hope trade. Because I don't think it's going to be the one that actually sticks. I think the second half of the year, we're actually calling for an AI bubble trade as the Fed starts to expand its balance sheet. And I think over the past, few weeks, the market sell-off was more driven by liquidity than anything else. So our liquidity indicator actually saw the sharpest contraction since 2022. And that's been a leading indicator of S&P multiples. And, with SOFR spread blowing up, funding market stress and all those things, that's essentially what happens. When liquidity drains up, everyone's risk curve shifts to the left. And the most speculative assets that's far out the risk curve, those assets get sold off the most. So things like Bitcoin, quantum, and all those things. And that basically speaks to the lack of liquidity in the market. And I think that's going to turn around going forward, which is bullish for equities.
Well, to that point, Howard Marks gave a really interesting interview to the FT this morning, where he said the people who are buying in this market have been traders and not investors. Mm-hmm. So it's not long-term holders that have really been participating in the melt-up that we've seen until last week and the week before. Do you see that same contour of the market? And does that fragility carry on into 2026?
Yeah, so it's really been traders and retail investors. And the latter is probably going to stick for longer term. I think it's a secular bull market that we're starting to see more participation from retail investors. And over the past few weeks during the sell-off too, we have seen retail investors buying the dip. So I think that's the big support for the market going forward as well.
You also write that value stocks are abundant, that over 50% of this market trades at a discount versus the 5-year average. We've seen so many false dawns with value as a factor doing well. What reinvigorates it this time around?
Yeah, I don't think value is going to do better in 2026. I think it's really the first half of the year, the reflation hope trade that we talked about, because there's a lot of physical tailwind that's coming in the first half of the year. So we're estimating about 80 basis point of tailwind from physical in 2026 for the full year. And most of that is actually in Q1 through the tax return. That's going to be bigger because of OBBB. And because of that, I think we're going to see reflation hope trade going forward. So we actually double upgraded energy and materials. I think retail is going to do well. I think some of the short cycle industrials that have really been beaten down over the past few years, I think those are going to do well. I don't think it's going to stick, though, because reflation means rates are probably going to be elevated. And surprisingly, this actually has been the most rate-sensitive manufacturing downturn in history. And I think for a sustained rotation out of AI, we need the manufacturing PMI to really recover. And for that to happen, this actually has been very rate-sensitive, and this actually has been a housing-driven downturn in manufacturing. So I think housing ultimately has to come back. So for that to happen, we need lower rates.
So this is really interesting because actually you and Mike Wilson are saying something very similar, which is that there was a complete withdrawal of liquidity or a complete backtrack of liquidity that caused this recent sell-off. It's going to force the Fed's hand. Ultimately, if this continues, the Fed is going to have to cut rates and potentially use their balance sheet. Do you agree with the balance sheet point as well?
Yeah, so our house view is the Fed starting to expand this balance sheet in April, buying the T-bills. And I think our AI bubble trade in the second half of the year is really predicated on the Fed starting to expand its balance sheet. More liquidity basically means better for speculative assets and long duration assets, which is basically AI. So I don't think we have yet seen the real bubble trade in AI. So far, the Nasdaq's outperformance, essentially since the end of the tech bubble, has been driven by better fundamentals and better earnings. It wasn't necessarily multiple driven. And I think we could potentially see a real AI bubble trade in the second half of next year with the Fed expanding its balance sheet.
Why did liquidity get so poor? We're talking about how anyone under the sun can borrow money until, the record scratch of, the hundreds of billions of dollars being sold in AI suddenly. Why now?
Yeah, it was kind of like a perfect storm, a combination of a lot of things. So first, there was QT, which is going to end in like 5 days now. And there was the debt ceiling resolution, so there was a lot of debt issuance to refill TGA, and the government shut down. So the government was collecting taxes, but not distributing back to the economy. So there was a liquidity suck. Also, a lot of those cockroaches that we saw. So the banks were getting more conservative when it comes to lending. So we saw the funding market really being stressed. We saw the SOFR spread really blowing up back in October. So it was kind of like a combination of all those things. Looking forward, the government is now reopened. QT is ending. We're probably going to see the Fed starting to talk more about the funding market. They already have started, and potentially increasing its balance sheet in April next year. And I think the risk is sooner. So if that happens, I think the liquidity issues are going to get resolved.
Ohsung Kwon, wonderful to hear your thoughts. Thank you so much. Come back again soon. Ohsung Kwon of Wells Fargo on those funding conditions. The idea of lack of liquidity kind of flies in the face of what we'd heard for earlier this year, but certainly a consistent theme this morning.
Yeah, that everyone could go to these debt markets and be okay. How long does that last? Do people allow the AI giants to continue to pour that level of debt into these funding markets?
Yeah, a real question, though, of funding markets versus corporate debt issuance. Very different. A lot of things to think through. Coming up tomorrow, we can discuss it all with Peter Scheer of Academy Securities, John Bilton of JPMorgan Asset Management, Samantha Dart of Goldman Sachs, and Pooja Sriram of Barclays. This was Bloomberg Surveillance on this Monday. Good morning.